Shout out to you, bro. Quiet soul in the building. Even that call worked yesterday. After the puts worked, when the market rebounded, even the call worked. 679 strike, getting in at 680. First profit target 682. That worked yesterday. While I'm putting my plans together, if anybody else has any plans that they would like to share, please feel free, put them in the chat. For the call. For the call. 682 call. 683 4 for the entry. Break and retest. 683.3 is a monthly area of resistance. Looking for a break and retest. We get above that. The next resistance is at 686. First profit target 686. Second profit target 688. Second profit target 688. For the put, if we're able to come back into this controlled selling algo, that's where I would like to see this put at. That's what I would like to see. Break and retest. So let's go with break and retest over yesterday's close. Yesterday's close was 680. So if we're able to get below that, let's say a 680 strike with a 679. 679.3 for the entry. 676 for the first profit target. Second profit target 674. All right, let's put this over on the big chart, see what that looks like. We got the news, see what the news looking like. Let us see what the news is looking like. this up, the big chart. See how that lines up here. Yesterday called out the 669.5. You got to the 669.6. Nothing is exact. Everything is probabilities. Perfectly fine with that. Put pre-market up here so let's see what's going on today. Okay. Very interesting. I said I like a 683.4 entry. I do. 686, first profit target. I like it. 688, second profit target. I like it. Want to see a break and retest with a 683.5. So I'm going to change this to 683.6 area with an alarm at 683.3. So let's go ahead and put an alarm there. Okay. And if this wants to come down, and if this wants to come down, very interesting. I need a little bit more room, space to see about this. If she wants to come down, clear support at the 675. Clear support there. So high up. Break and retest it at 679. Possibly. We broke it. Reclaimed it in pre-market. We're going to have to go just a little lower. I'm really not liking a put. I'm really not liking a put at all. At all. I'm not liking a put at all. I'm not liking a put at all. It's a lot of support all the way down. Support at the 677. Support at the 675. Right here, we did not close outside of this algo. We touched it here, bounced back, touched it here again, and bounced back. So far, we're in a state of indecision right now. I like the call area. I do not like. I don't like the put. You see all of this support, this tail? These are bulls rejecting lower prices and buying up lower prices. It's a lot of support down. A lot of support. And even this week, this is a weekly candle. We're in a state of indecision. See what that daily candle look like. Again, Clearly showing support, as I said, at the 675. Showing support again at the 680, which is why I like a call above that 683 with a break and retest, continuing in this uptrend, getting your money from Monday's post and pre-market bears who started covering yesterday. We get above that 683. Let me show you where I'm looking at, where my money is going to come from. These bears right here covering. We get above that 683. 686 is natural. We get above that with a measured move that brings in the 688, possibly the 689. Before a put, I don't see it. This is a 4-hour chart that I'm looking at right now. It's so much bullish strength, post-market, pre-market. So where on here, if you were a bull, where would you be in trouble? You could possibly challenge a 679. Say with a 680 strike. Let's look at that. I got that 680 strike. 679.3 for entry. I don't like that. So I'm going to move that down to 679. Flat out 679. I said 676. The market is showing 677. Let's change that first profit target to 677.2. Rather, 677.3. Second profit target, 674.8. Okay. So let's put an alarm also at 679. Really almost 680. We'll put an alarm there. We'll put an alarm there. It's a 4-hour. So we're talking about 9, 10, 11, 12, 1:30. About 1:30. So this might be an afternoon trade. A put might be an afternoon trade. It might be an afternoon put. Per chance, your honor. Maybe an afternoon put. I don't know how these. When is this 4-hour up? Okay. It's going to be very interesting. Very interesting. That's the 4-hour. It's the 1 hour. Huge, huge bullish strength right now. It just is what it is. It's the 1 hour. It's a 30-minute. That's still kind of tight. I see why I said 179.3. But I like the 179. I mean the 679 for that put still. 679 for the put can possibly bring it down to 674. First profit target 677.3. Love a call though. 680 is a beautiful area for a call. is a sweep area back to the bullish sentiment if that does happen. Again, looking for a break over the 683.4. This is a monthly area of resistance. This purple line on my charts represent a monthly area of resistance, and you see us going right to it. And we're in between these two monthly areas of support and resistance. If we break over the 683.4, then I am bullish. Big strong algo coming from post-market into pre-market. Will that, roll over into market open? I have no idea, but we still do need to identify it because it is definitely very real. Very real. And there it is. Matter of fact, let me double it up just so it's seen clearly. Okay. So that's why I like that 679, because we would be breaking out of this algo. But in order to get me involved, what I'm looking for is a close, like Sir, Your Honor, and then let me see, how can I do that real quick? I like that. Let me do that. Okay, that, and then something like that. That's just where I would be looking to get in at. If we are able to break this algo with a close, this will be the confirmation. The following candle would be continuation down to the first profit target, 677, and then potentially down to the next profit target of 674. This is what I would be looking at with an entry at the 679. Like that. That is what I would want to see for a put. Well, let's see what happens. For a call. For a call, I would like to see the exact opposite. A break and retest with the 683. And then going that way. So that's where I'm at, guys. Plan is set. Alarm is set. 683.4 alarm. Looking for a break and retest of this area. Love it that it hit it, but it's got my attention, but it's the first 5 minutes. So we want to see what happens right after that. We know this area is an area of monthly resistance. So all I'm going to do is just reset the alarm. Okay. Alarm has now been reset. Looking for a break and retest to get my attention for a call. If that doesn't happen and we fail, this is what I want to see to get involved. Let me show it to you also on a trading view chart. Looking for that break and retest to get involved in this call here at this 683.6 area. Okay, if that does not work, and also you can see here, guys, why I don't see any calls. See any puts. There's no put action here whatsoever. We've been strongly bullish since yesterday afternoon. Okay, strongly bullish. So in order for the tables to turn, I would have to be convinced, and we would have to then be falling out of this control buying algo into a control selling algo. I don't even like that until the 679 area. It's just that simple. Calls above 683.4, puts below 679. Now, on to the team. Shout out to everybody, and thank you for coming on in and joining me today, being a part of this journey. Thank you for sharing your journey with us as well. Thank you for hitting that like button when you come on in here. It does help. I don't know what it helps, but I just hear other people say it, so I'm saying it too. Thank you for hitting the like button. It does help. So I do appreciate you. Salute to you for doing so. Kick is going out of control. We are really growing on Kick, and I can't thank you guys enough for tuning in on Kick. And I thank you for being patient with me during this month of Ramadan. I haven't been as active as I want to be because simply I'm fasting, and so I don't have the energy nor the drive right now to do a bunch of extracurricular things, but I am showing up every day, coming up with this game plan, trying to make sure that myself and the team is safe, and if I can do my best to help us get to the bank, please believe I aim to do that each and every day. Just wanted to show you what I was looking at here. Hope you got a screenshot picture of it. That is what I'm looking at. And again, this is the 30-minute chart. So let's go ahead and break that on down. Get back to the 5 here. Want to look at the higher time frames today, team. Definitely want to look at the higher time frames today. Okay. For those of you who are new joining us, especially on Kick, I want to explain to you what you're looking at. Top right corner is the daily chart. Top right corner is the daily chart. Just trying to find a nice little view of it real quick. Okay, that's acceptable. This is acceptable. Bottom right corner, right here next to me, is the weekly chart. Here's the weekly chart. And so far this week, the Bulls do have control. So far this week, the Bulls do have control. Bottom in the middle is the 30-minute chart. Looking at that, picking up from yesterday's action. On a 30-minute chart, I'm going to go with that view right there. Sufficient. Bottom left is the 15-minute chart. We definitely like to look at different angles, different views of the same instrument. You want to see your move setting up on the larger time frame first, and then coming on down to the lower time frame for your entry. Top left corner is a 2-minute chart, 2-minute Heikin-Ashi. Can already see that bearish rejection. Can already see the bearish rejection. First 5 minutes, very volatile. The first 15 minutes can trick you. Let's give the market a little bit of time to show us what it would like for us to see. right to the bottom of the algo and then finding a bounce. Top middle is the 5-minute chart, where we primarily look for our trades off of the 5-minute chart. But we want to make sure that it's lining up with the larger time frame. We don't want to take a call if the 30-minute chart is showing us bearish sentiment. You don't want to take a put if the larger time frame is showing us bullish sentiment. And if you do, just know you can't marry it. Treat it like a scalp. Scalp it, get your money, and be done with it. Shout out to you guys giving the market some time to present itself so you don't get caught up in that trap. Again, looking for a call above 683.6. Looking for a put below 679. And it's like that. Let's talk about money. The chat is open. See what's on the team's mind as the market price is coming right back down to the bottom of this algo. Also, let me change that to a little bit of a support, wrong color. Big shout out to the team. Quiet Soul is in the building. Todd Macon, Nkosi, Jesse Swanson, Jared Lewis, Big Ben is in the building as well. And a big shout out to those of you who are kicking it with us on Kick. Thank you. Grateful Day, team. Sitting right on this algo. Let's see what happens here. Clearly see the support here at the 679, rather the 680. Clearly see the support at the 680, which is why I like the 679. We've identified this beautiful control buying algo coming into market open. news. And Coach, he said he's looking for a pre-market high break and retest. And he also likes a 679 put as well. Alrighty, thank you team for sharing that. Do appreciate you. The news that's coming out right now, stocks climb as Middle East hopes drives oil lower. Very important day today. This wonderful Wednesday, March the 4th, first week of that week of March trading. Market just got my attention with that 680 break. We're looking for a close here as we are starting our next 15-minute candle for you ORB traders out there. Got a few ORB traders on the team. This is some of that action that we are definitely looking for. Come on, 10 o'clock. Let me bring up the trading view chart one more time. You can clearly see that rejection at that 683. We got there, but we did not get the break and retest, so the call was invalid. We did not get into a call here because we did not get what we wanted to see. We wanted to see a break and retest of a 683.4. That did not happen. Instead, we got rejection. We're now looking to see if we start forming and falling into a controlled selling algo. That 680 area is going to be key. If we're able to break it, as I showed you in that diagram, look for a 679 entry. If that happens. Remember, guys, we only deal with probabilities. We don't deal with certainty. We deal with if and then. If the market does that, then we'll do this. If the market does this, then we'll do that. We don't try to predict. We only react to what the market is doing. We look for those key areas where we know there's going to be some potential conversation between the bulls and the bears as far as control is concerned. We've identified that on the chart with the 683.8, an alarm set there, and I'm going to re-establish that 679.6 alarm. Again, so far the market has hit both of our alarms. It hit our alarm in the call direction and then was rejected. It then hit our alarm in the put direction and then bounced away from it. There is nothing to do now but remain patient. And Kosi just reminded us, he said MAGS, M-A-G-S, they moving on a 5-minute chart. MAG stocks are 30% of the SPY. Go here to look for that. And we see Meta is green, Nvidia is green, Netflix is green, and Tesla is green. We also see the SPX is green as well. So the market is definitely moving in a bullish sentiment at the moment. Thank you, teammate.
Yep. Names like Coinbase today. Meantime, live shot of the Supreme Court today. As it is a decision day, we are on watch for a possible decision about Lisa Cook, that governor. We'll watch that as we get closer to the top of the hour. In the meantime, Stop Trading with Jim's next.
Kosi reminded us RSP is still going down. What is that? What is RSP? And Kosi, what is RSP? RSP is the SPY equally weighted. It removes MAGS influence. Okay, thank you. Thank you. You guys know I don't claim to know anything. The only thing I can do is read. I can see what the stock market charts is trying to show us. And those two areas we have identified. Again, we got a rejection from the 683.7 area, and then we got a bounce from the 679.7 area. So stuck in the middle, remaining patient. The market is in a doji, which is also a state of indecision. You can look at the daily candle right here on the top right. The market right now is in a state of indecision. And it just so happens, coming into the day, we had an alarm looking for a break of the 683.6 going up higher. And we're looking for a break and retest of the 680 going down to the 679 going lower. These were the two areas that we called out this morning for our trade. 682 strike price, looking for a 686 profit target, then 688. And then also a 680 strike price, looking for a 679 entry, targeting 677 and then 674. We believe that those might happen, and if it does, then we will entertain possibly getting into one of these positions. As of now, the market is in a state of indecision, though there's absolutely nothing to do until big money decides what it's going to do. Once it makes a decision, we will do the same.
Time for Jim and Stop Trading.
Okay, one of the stocks that really marked the top in the 1990-1991 Gulf, the first Gulf War, was Exxon. It went up, going into leading up to the war, and then it went down when the war started. We are at a pivotal level for Exxon right here. If it does go and take out about 146, then I think you're going to say, all right, we're in the same situation as that Gulf War, which was the peak, and next people realized the United States was going to win, and win decisively. So let's keep an eye on Exxon as a tell on whether we're going to win or not.
Yeah. The other interesting name, Jim, we didn't really get to it, is Dow, which got an upgrade today, but has been a huge winner this year.
Yeah.
Thinking about the Strait, a lot more goes through the Strait than just oil.
It's amazing because it is a bit of a China play, but also Jim Fitterling, to his credit, really kind of reined in a lot of the things he was doing. Some of them that were definitely more, he's very proud of his work for the environment, but they had to scale them back, and he has done a great job preserving things. He did have to cut the dividend, but I wish him the best of luck. He was he got hostage to some really bad commodity prices, and he seems to be working his way out of it, which is great.
Yeah. Key today goes to overweight. How about tonight?
All right, so I do have CrowdStrike, which again is a battleground stock because there's some people who feel that you're going to be able to disintermediate these kinds of stocks, which is cybersecurity. And George would say, do you really think Anthropic is the company that you would call to say, listen, I know that there's a lot of threat actors out there from Iran and Russia, and I want you to do it? And I think they would say, well, why don't you call my partner George Kurtz? But the negativity is still there, and David, I think that the negativity is not going to go away anytime soon for companies that are Anthropic's alleged crosshairs. Anthropic has to come out and say, you know what, we don't want to do anything against Clorox, and we are fine with that.
I don't think they're going to come out with a company-by-company list of those that they don't threaten.
They're not going to save the potato chip market?
I'm not worried about the potato chip market.
Thank you very much. Then I'm fine.
Jim, we'll see you tonight. Mad Money, 6 p.m. Eastern Time. Relatively flat market. Breadth's kind of even. S&P up 8, Dow down 30. Don't go anywhere.
Damn, you didn't even hear a word I said. You didn't hear a word I said, man.
Good Wednesday morning. Welcome to Squawk on the Street. I'm Sarah Eisen with Carl Quintanilla and David Faber. We are live as always from Post 9 of the New York Stock Exchange. Coming up this hour, we will talk to former Treasury Secretary and former U.S.
Is a good sign. 66.6. The evil number in the rearview mirror turns into 63.0. That would be the smallest price it paid, the inflationary component, going back to March of 25. Now, if we look at new orders, we're looking at 58.6, well above 53.5, well above 53.1 in the rearview mirror. 58.6, that would be the strongest since September of 24. And finally, the employment side, which is key considering we had ADP today and we have the big February jobs report on Friday. 51.8. We were looking for 50.6. Rear view mirror 50.3. 51.8 would be the best going back to February of 2025. We see right now that we're at 407, up 1 basis point in a 10-year, and at 351 in a 2-year is unchanged. Treasury market through all of this has, for the most part, been quite calm. Sarah, back to you.
Okay, thank you, Rick Santelli. As for the rest of the markets, just want to check where we are as we enter day 4 here of the strikes on Iran. Obviously, energy and oil prices and gas prices, that's at the center of the storm. And actually, there's some give back today. Not a lot, but crude oil here in the U.S., it's down 0.75%. Brent, the international benchmark, down 0.5% after we saw a big jump over the past few days on disruption concerns. Maybe it's helpful that President Trump did say that the U.S. would help escort ships through the Strait of Hormuz if necessary to get that oil flowing from the Middle East. A few other key hotspots in terms of market ripple effects from what's happening in the world. The Korean market, the Kospi, you guys, it had a record fall overnight, down 12%. So the hottest market in the world goes really into panic mode. It's only been open 2 days this week, but in that time it's down about 17% in that time period. What's happening here? Well, Korea is a big importer of oil and gas. So when prices spike, there are concerns there, and it was a one-way bet on the Korean market, right? There's a lot of leverage in that market. There's a lot of retail trading, and when it snaps and goes the other way, that shows the danger of this sort of high leverage, high margin retail euphoria that's been in the market around AI. Names like SK Hynix and Samsung. I mean, it can be a violent correction.
Well, it's a momentum market, I think,
True.
said another way.
Yeah.
And the momentum, obviously, when it comes to the memory makers, as you point out, Samsung and Hynix, which led the Kospi higher last year, reverse course. Interestingly, they actually did not suffer the same losses in this latest daily rout as did the broader market.
Yeah, true.
Hynix and Samsung actually were down, but not nearly as much.
I think part of it is also, I mean, and you look at the iShares here, the MSCI South Korea ETF. I mean, we saw 1.2 billion in inflows in the week before the Mideast turmoil. So momentum speculation, I think, is another way to say it.
Yes.
Right? There's just so much money that has been piled on one side of this broad trade, and I think it relates to the next one that I'm watching, which is silver, because that's also kind of snapped back the other way. One of the most popular trades of the past year. It's getting a little relief today, but we saw a pretty big correction, almost 50% reversal from the January peak on silver. Gold hasn't held up as much as everyone wanted. So those are trading like sort of highly speculative retail trades in a way, and so you're kind of seeing the reverse impact of that.
But isn't gold? I mean, gold is up now, but isn't it also tied to the dollar? And as the dollar's moved higher,
Dollar's stronger
that
for
has
sure.
impacted
Yeah,
gold
there's a
to
trigger,
a certain extent.
but the moves are much more violent than say like the moves that you're getting in the U.S. dollar. And I think part of it is just when margin calls are triggered, retail traders have to sell whatever they can, and that's why you look at equities into precious metals, because that's been a big point for that. The only one I also wanted to mention, if we're looking at sort of other places in the world being affected, is Spain, because it did open lower after President Trump said he wants to cut off all business with Spain. It's come back. It's now up 2.25%, but this is obviously, Carl, one that we're going to watch carefully because we're the sixth biggest export market for Spain. So it's not like of utmost importance to them as compared to some of the other European neighbors that they trade with more, but clearly, it's a big deal.
Yeah, comments out of the EU today saying, look, we've negotiated as a bloc. You're not going to alienate one of our members on a deal that we think we already have, so that we'll see.
Sure. If you negotiate as a bloc, though, that should apply to defense spending as well, and the fact that they want to go against Europe and not spend as much on their economy for defense spending. I mean, Europe, even Chancellor Merz of Germany yesterday said, we need to get Spain there. So this has been sort of a long-running fight between the U.S. and Spain, and it's bubbled over when they didn't let us use their
I'm
bases.
not sure where that is that's not in the trade agreement, but that's a totally separate issue.
No, but IEEPA did not take away the powers for trade embargoes. They took away the powers for tariffs, or at least they said that was illegal. So I think that on the embargo front, the president feels pretty good about the legal case there.
Yeah, although yesterday he said we won the decision on tariffs, which was curious. As we move to the broader markets, stock stabilizing a bit here. Dow's up 20. Let's bring in Phil Camparelli, multi-asset solutions portfolio manager at JP Morgan Asset Management. Phil, it's good to have you.
Carl.
Thanks for being with us. What do you think the market's trying to tell us right now?
Day 4 of the crisis, Carl, and we are not changing our posture and leaning into risk in our portfolios. So the information that we have now, there's no reason for us to change. I think what the markets are saying is they're conditioned to these things. These things pop up every year. Russia-Ukraine, 2022. Silicon Valley, 2023. Right, the Red Sea piracy in 24. Last year, Liberation Day. Diversified portfolios work in this environment. I think the one risk that we would look at is our oil prices. Oil prices do a couple of things for us. Obviously, the lack of protection that you're getting in bonds keeps us up at night a little bit, because as oil prices went up, bond yields went up. But just the outright level of oil prices, $75, not problematic. We traded about $81 on average in all of 2024. The economy did fine. The Big Beautiful Bill Act delivering about $150 billion of consumer fiscal stimulus. Every $10 in oil prices takes away about $30 billion. So, Carl, it's like a drop in the bucket so far. And then just the forward markets. The forward oil price is trading at about 68 right now. Inflation break-evens, the Fed's favorite measure, five-year inflation break-even, 2.3, unchanged, even lower. So I think what the market is telling us here is that investors have become conditioned to geopolitical issues and has been proven to look through.
Yeah, there's been some debate about that. The last time oil prices spiked like this in 22, you had the Fed near ZERP, you had income and housing booming, you still had stimulus running through the economy. Right. We don't have any of those things right now.
No, but the Fed was hiking rates later that year by 75 basis points a meeting. Right, so you had Russia-Ukraine in March of 22, and the Fed kept hiking rates and tightening policy. We're in a much, much different place when it comes to monetary policy. The Fed has taken 175 basis points off of that terminal rate in the past 2 years.
Right, and the 10 years barely moved.
That's my that's my favorite measure, 4.1%. That's where we were in the September FOMC meeting. That's where we are today, and interest rate vol has been very low. That was such a distraction for equity investors over the past few years. I think it's a green light to take risk now, but also on the 40 side of the 60-40, when the 10-year doesn't move, it also provides protection when equity markets are selling off. But still, the number one risk for us would be wrong way correlation between stocks and bonds, which reared its head a little bit on Monday and Tuesday. But 4.1% is not problematic for us.
Right. The other thing is whether or not it's time to play a reversal in semis versus software, given the incredible dispersion there.
Yeah.
And then whether the private credit discussion has gotten less worse.
Yeah, so our last trade when we got more confident in the U.S. economy in February was to add to two sectors, communication services and tech. We got more bullish on the economy than it was there. We have about a 14% earnings growth forecast for the S&P this year. That has to include mega cap tech delivery. So we are certainly buying into that trade. And then on the private credit stuff, listen, it was a proliferation. There has been no advisor that hasn't heard about private credit over the past few years. With that is going to come some defaults. A famous bank CEO used the word cockroach, right? So that is going to happen. And with spreads this tight, you're going to see some spread widening, but Carl, not a fundamental risk for us. We're still overweight equities, we're still overweight public credit in portfolios, but we wouldn't be surprised if there were some defaults in private credit for sure.
Right. We'll be watching the rates, I guess, over time,
Yes.
Philly. Good to see you. Thanks for coming in. A lot going on. Phil Camparelli.
All right, here's our roadmap for you for the rest of the hour. When we come back, Pennsylvania Senator John Fetterman is with us ahead of a key war powers vote in Congress this afternoon.
Plus, we're going to talk to the chairman and CEO of Victory Capital. It manages about $300 billion, and it is bidding to acquire the asset manager Janus Henderson, which is already in a deal to be acquired by Trian.
And former Treasury Secretary, former ambassador to Israel, Jack Lew's with us. We'll get his take on Iran and some of the new tariff details we got from the Treasury Secretary today on Squawk. Stay with us.
That's in a tease.
Welcome back. The Senate expected to vote today on a resolution that would prevent President Trump from taking military action against Iran without congressional approval. Our next guest is one of the very few Democrats to publicly oppose the bill. Joining us now first on CNBC is Pennsylvania Senator John Fetterman. Senator, welcome to the show. It's good to have you. What are Democrats trying to do here?
Well, I can't really speak for the rest of my colleagues in the Senate because I believe I'll be the only Democrat that's going to vote against it. So I think there's been like an emerging kind of dynamic. I think it's, to be objectively fair, that I think the things that happened so far has been very, very positive and a strong development overall. You know, every single senator says we should never allow Iran to acquire a nuclear bomb. And that's happening right now. Things that makes it virtually impossible to do that. And I also say that many senators are saying, I'm not going to weep that the Ayatollah has been erased. Well, why can't you just say it's been a good thing that he's been killed? And now if a lot of good things are happening that we all wanted, you know, why can't we all just agree that overall this has been a positive development? And now it's like you're not part of the Democratic Party right now to just say, hey, I support the things that happened so far.
I guess they just can't give Trump any sort of win or authority. I mean, Senator Schumer,
Exactly. That's what's driving it. You know, it's just like, why can't you just admit, like, so a lot of really good positive things happen, and now, like, you know, so it's absolutely, I'm proud to stand and support Israel. Now, if so many things that you've claimed that you want, that we acquire a nuclear bomb and that this regime is evil and incredibly destructive, both of them have been effectively ended right now. Why can't you say, well, maybe this was a good thing now? Because I know why. Because the base demands that you can't agree with Trump on anything.
Have you been reprimanded?
No, they know that would be a waste of time if they did, because, hey, I'm proud to be on the side for Israel, and I'm going to be on the side of the country. And now, why say things to never acquire a nuclear bomb and this regime is evil, you know, and what does that mean? Are you really willing to support the things that made that possible? I mean, or is it just empty rhetoric? Because for me, that sounds like that it was. Because now, if that happens, you know, objectively, why can't we just agree that so far this has been a good development? That doesn't mean that there are plenty of risks. And I'm never going to have a mission accomplished, you know, kinds of moment that happened back in the Gulf War. And this is nothing like that. And this vote that's coming up, remember, people, that the War Powers Resolution in 1973 says the president has to put a 48-hour notification, and he has done that. And then there's up to 60 days and perhaps a 30-day extension. And neither one, that's not really part of the situation right now. We're 4 or 5 days into it.
So Senator Schumer, I was just going to raise this, the minority leader, said that his argument is this is a war of choice, not necessity. He said there's one thing almost everyone agrees on. We are sick and tired of endless wars in the Middle East. That there's this view in the party that A, the president doesn't have a plan, the administration hasn't laid out clear objectives, haven't convinced the American public, and that they've jumped the gun and sort of have done this not because they need to imminently. These are some of the arguments.
Well, I think my party's been wrong on the Middle East after 10/7. You know, my party was demanding a ceasefire early on, and that I believe that was always the wrong thing. And now they pushed through that, and what Israel accomplished. Now they were able to break Hamas, and they were able to break Hezbollah, and they were able to break Iran and establish that. And made me the only Democrat that supported striking the nuclear facilities last year. And now here we are. You have an opportunity to have true peace, because we all agree that Iran was the disruptor in that region, and they've been effectively broken. And the only thing that they've been able to do is just fire off these cheap, junky drones trying to create chaos. But the real truth is they never really had a shot to shoot at this point, and that's clear. There may be more chaotic things. And absolutely, I agree with the families of the service members that they lost. Here we are. I think we could agree that this is a great development for regional peace.
Meantime, Senator, got the primaries last night. A lot of game theory going on about the midterms this fall, what might happen in North Carolina or Maine or Texas or even Alaska and Iowa. Kalshi has 45% odds that the Dems take the Senate. It was 30 coming into the new year. Is that something you'd be anxious to see?
Us in the majority?
Yeah.
Well, yeah, of course. I mean, I'm a Democrat. I mean, that's part of the truth here. It's like, yes, I am a Democrat, and I might disagree on things, but I would remind people if that does happen, that math means it would have been 51-49, and then that would put me on the cusp of that and make it possible. And I flipped a red seat. Now, Democrats, you want to criticize a committed Democrat that flipped a red seat, that makes it now, well, I think you said it's 45%. I haven't seen that, but if that is true, then that's because it's required to flip red seats. Now it means I'm going to always pick country over party and call things are objectively a good thing are. And now I will push back against my base and say, hey, look, I think I'm right about this. I think you should too.
Yeah, I do wonder, though. I mean, I know you say you're a Democrat, but I wonder who you see as the future of your party, Senator Fetterman. Gavin Newsom, who a lot of people are watching, the California governor, he said yesterday on a podcast, he likened Israel to an apartheid state, said leadership has left the U.S. no choice but to reconsider military support for Israel. I mean, your party is moving farther and farther away from supporting our ally.
Well, sure. I mean, I was always willing to be the last man standing in the Democratic caucus, standing with Israel, and essentially that's where I'm at. I mean, as polls continue, people will follow those kinds of polls. I think there's moral clarities, and I'm never going to abandon them through this. That's why I'm here now, why I'll be the only Democrat that's going to vote this down later today, and it has no mathematical pass at this point.
Do you support it? Would you support a trade embargo against Spain for not letting us use their base?
I never knew Spain seems pro-Iranian. I'm not really sure what that means, but if Spain wants to stand with Iran and stand with that, that's incredibly disappointing. But that's also probably the issues in Europe. You know, when during the Gaza war and humans were kept underground for 2 years, many of our allies were just let's acknowledge about Palestine. That's a betrayal to me. Now, why not just say until everyone's released, until there has to disarm? Maybe then we'll recognize Palestine. Why do that when they're torturing and keeping people underground? That's kind of the issues within Europe.
All right, Senator John Fetterman, always appreciate the time and your views. Thank you. Ahead of this big vote today.
Okay, yeah, well, I think it's at 1 o'clock today, but yeah, we'll see, but you'll know where my vote will be.
Thanks for coming on to talk through it. Senator John Fetterman in Washington.
Still to come this morning, former ambassador to Israel, former Treasury Secretary Lou's with us. We'll get his read on what a prolonged Iran conflict might mean for the balance of power in the Middle East. Are higher oil prices here to stay? We'll talk about it with Goldman's co-head of global commodities. First, though, the latest in a battle over the fate of asset manager Janice Henderson. Victory Capital, of course, joining that bidding war. Their chairman and CEO is next, as the market did like ISM, NASDAQ up a full percent.
San Antonio-based Victory Capital trying to break up Trian's deal to buy the asset manager Janus Henderson. Now, the asset manager Victory Capital has put forward what it calls a clearly superior proposal, offering total consideration worth about $54.15 per Janus share. The bid does include $30 a share in cash and the rest in stock. It would give Janus Henderson shareholders about a 38% ownership of the combined company. Joining us now in a first on CNBC interview is Victory Capital's chairman and CEO, Dave Brown. Good to have you this morning, Dave. First of all, I guess, you know, Trian has a deal, $49 a share cash. They own over 20% of the company. Why are you even trying here to buy Janus Henderson?
Well, first, good morning, and thank you for having me. You know, this, for us and for Janus, can create an unbelievably competitive and scaled company that can compete with the largest asset managers in the world. You know, our proposal, which is superior, really gives the Janus shareholders the best of both worlds. A majority of the consideration is in cash, and then the rest of it is in a pro forma company, which they'll own 38% of, which is going to be unbelievably competitive, create billions and billions of dollars of value that the current Janus Henderson shareholder can participate in.
Yeah, you listen, there are plenty of investors certainly in the company who would agree with you, Dave, but many of them also come back to the vote. You need 2/3 of those shares voted to vote in favor of your deal. Trian owns over 20% of the stock. I think 81% of the total was voted at the last annual meeting. The math just doesn't seem to work for you when it comes to the ability for you to actually get the vote in favor of your deal.
We have a clear path to get the deal done with or without Trian's vote. We're well advised. We've studied all of the voting, the way it would work, and we feel confident that the Janus shareholders will show up and vote for the superior proposal.
I mean, but Dave, the math is really tough. I mean, even if you get, let's call it 90% showing up to vote, I mean, the simple math is you need almost every share to vote in favor. I think it's what may have given the special committee pause. If you could have gotten a voting agreement with Trian, it might have been a very different thing. You really feel like you have a path here to get the vote in favor?
I do. First, I'm highly confident we have a path. You know, the special committee has not engaged us to have any discussions or any meaningful discussions around any of this. This is a superior proposal from a non-inside bidder that is the best of both worlds. Majority of cash up front, ownership in a combined business that's going to create a lot of value for the Janus shareholders. So I'm confident that there's a path to get this completed.
All right. Well, you know, I think we haven't heard from Trian, obviously. I would also point out they know their way around a vote, and they can, you know, solicit proxies against or votes against. It's going to be a tough one for you. But that said, in terms of your bid itself, it's very similar to what you had said, or at least we saw in the background of the transaction. You know, the ratio is roughly the same, the cash is roughly the same, your stock price went up, hence the value of the overall deal went up. Is there a scenario under which you could see raising your bid or making it all cash?
So we're focused right now solely on having the special committee engage with us. We're not going to get ahead of the process on anything. We're really focused on getting them to engage with us. We've submitted a superior proposal, like I've said. We're waiting to hear back from them, and we're hoping that they do the right thing.
And the right thing would be to engage, even though they really do have doubts, I would argue, about your ability to actually garner the vote if Trian is against you?
Yeah, we want them to engage. We want to have discussions. We want to talk to them about our proposal. We want to talk to them about the nuances of our proposal. And at the end of the day, this is a better financial proposal and other areas than what they have with Trian. Our proposal is a 37% premium on the unaffected share price before the Trian announced that they were putting an offer in. It's a materially higher bid than what Trian has on the table. And so I think in the best interest of the Janus shareholders that they should engage.
It does rely on you garnering as much as $500 million in synergies to take the leverage down, because you're going to leverage up your company if you were successful. What gives you the confidence? I think that amounts to about 23% of Janus's overall cost base. And by the way, half of their cost is outside the U.S. where you don't have operations. So I'm curious as to how you're confident you can deliver what is a very large synergy number based on the overall size of the transaction.
Yeah, we're highly confident. If you look at our history, I think our track record speaks for itself. We've done 8 acquisitions in the last 12 years. We've accomplished all of our synergy targets. In many instances, we've actually exceeded them in a faster time frame than we had planned. As you said, it's 23% of the operating cost. You go back and look at the last 10 years for our industry and look at the transactions that have been done, 27% is the average. We actually average higher. So I'm highly confident in our ability to execute on the synergies. And I think executing on the synergies is going to get us to the place where you have a competitive company of size and scale that can compete with anybody.
Even without having overseas operations, you're still confident you can get to that number.
We actually have clients in 60 countries around the world and over $55 billion in assets outside the U.S.
Finally, Dave, you made this kind of unusual decision to send a letter to Janus Henderson employees talking about the benefits of the transaction for them. Their CEO responded with a letter to his own employees questioning the appropriateness and culture of a competitor that is making an unsolicited, non-binding proposal for our company to write an open letter to our employees, going on to say it's an attempt to put pressure on all of us using very polite-sounding words. How do you respond to that?
Well, I wanted to communicate directly with the employees and have them hear from me in my words, since we were not able to do that, given the special committee did not engage us. So I wrote a letter, and I think what the letter was put into words was how our culture is, how the operating environment is, and what the opportunity for the combined company is going forward, and for them to hear directly from me, since we were not afforded the opportunity to do that because the special committee did just not engage with us.
All right, we'll be watching, of course. We'll bring you back at some point to talk about the markets as well. But Dave, appreciate your time today. Thank you.
Thank you.
Meantime, S&P just about 5 points shy of going green for the week. Let's get a CNBC News update with Pippa Stevens. Hey, Pippa.
Hey, Carl. Cuba charged 6 people today with terrorism following an alleged gun battle last week between a Florida flag speedboat and Cuban forces. Authorities in Cuba claim the exiles said they came from the U.S. to cause chaos and attack military units. 4 Cuban nationals were killed and 6 survivors were taken into custody. U.S. politicians have cast doubt on Cuba's version of events and have called for independent investigations. Democratic Representative Jasmine Crockett conceded today to State Representative James Tallarico in the Texas Senate primary. She called for Texas Democrats to rally behind him in the upcoming general election. He will face the winner of a runoff between Senator John Cornyn and Texas Attorney General Ken Paxton. And Homeland Security Director Kristi Noem is back on Capitol Hill this morning, this time for a hearing with the House Judiciary Committee. It comes after she faced criticism for her department's immigration crackdown during Senate testimony yesterday, where Republican Senator Thom Tillis called her leadership a disaster. Sarah, back to you.
Okay, thanks, Pippa. Up next, former Treasury Secretary and former U.S. Ambassador to Israel, Jack Lew, with his read on the war in Iran, inflation impacts, and the administration's new details around tariff plans. And an exclusive you do not want to miss on Fast Money tonight, Salesforce CEO Mark Benioff. We'll be speaking with him at 5 p.m. Eastern Time. Don't go anywhere. Welcome back. Defense Secretary Pete Hegseth saying this morning, America is winning decisively, devastatingly, and without mercy in the war with Iran, adding more bombers were arriving and the assault on Iran is accelerating. Let's bring in Jack Lew to discuss the latest. He is the right guy for this conversation. Former U.S. Treasury Secretary, former U.S. Ambassador to Israel, currently a Columbia University professor of international and public affairs. Secretary Lew, welcome back. It's good to have you.
Good to see you, Sam.
So I was very curious to hear your take on this war and whether President Trump is justified in doing it.
This is a little hard to answer that question, Sarah, because I haven't heard a clear explanation of why we're doing what the goal is. I think the administration could have done a much better job explaining to Congress and to the American people why we're committing U.S. troops and enormous amounts of U.S. treasure into this battle. No one has to tell me how evil the Supreme Leader or the IRGC are. I was in the room with the Speaker of the House when our Marines were killed on a tarmac in Beirut. I was in the cabinet room with the President of the United States meeting with the families who were killed on the of the servicemen and women who were killed on the USS Cole. So I get exactly why we're talking about having an evil enemy here. The question is, what is the goal of the war? What is the purpose of the war? What will it achieve? How will it end? Where is it going?
Isn't it just to neutralize the threat and to not let them be a nuclear power?
You're going to have to ask people in the administration that.
They've said it.
In June, when we attacked the nuclear facilities, the administration, the president said we obliterated their nuclear power. I don't think there was any immediate threat of nuclear breakout that was the trigger event here. I personally would like to know what the trigger event was, what made it so immediate. I think a lot of Democrats are not saying on the merits they want to support anything having to do with being soft on the Iranian leadership, but they're saying, why are we going to war? Why didn't you consult Congress? Why aren't you explaining it to the American people clearly? Zigzagging explanations, different goals, 4 or 5 different objectives. They're all different, and it's just not the right way for America to go to war to do it that way.
So what ultimately do you think will be the upshot of all this, the pushback from the Democrats in Congress? Because, President Trump is moving forward with this, and he said he's going to take as long as it needs to happen, and they're having incredible success.
Look, I think as a practical matter, the debate over the War Powers Act is important, but the way the War Powers Act is structured, the way the Supreme Court has interpreted it, it's unlikely to have any impact, even if there were to be a vote rejecting, because the president gets to veto that and it would not be overridden. The real question will come when they come for funding to replenish the Department of Defense. I've done a little back-of-the-envelope calculations about what the cost is. I've run out of zeros. It's really expensive. There were public reports it was almost $1 billion of ordnance in the first day. We're using hundreds of missiles where the unit price is $4 to $15 million. It's a staggering amount of money. And I'm not saying we shouldn't use our military force for a good purpose, but it's incumbent on the president and the administration to clearly explain what we're doing and why. And we have a constitution that says Congress declares war, and to go to Congress and to have Congress speak to it.
President Obama had a number of military strikes without getting approval from Congress.
Well, we could go through different examples over the last 25 years. This is singular in terms of going around Congress. I'm going to go back to the 1990s when we went to war in Kosovo and we didn't have a direct vote in Congress. I was in the Yellow Oval Room in the residence of the White House with the president, meeting with hundreds of members of Congress, answering every question, explaining everything. There's just been a disregard for our constitutional process that's troubling.
If the outcome of this war is regime change, which conceivably would be a real positive, perhaps, for the overall region, I'm curious as to how you think it would come about. You've obviously been ambassador to Israel. Mossad is clearly very involved here, deep into Iran in some ways. Do you think it's a realistic expectation that there could be a regime change?
Look, I think experts for a long time have feared that if there were a toppling of the regime, the most powerful force in Iran is the IRGC, and that you could easily have a consolidation of power in a very evil leadership group. The president even said yesterday that that's the worst case outcome. He was acknowledging what every intelligence briefing I ever had made clear was one of the possible outcomes. I don't know what the outcome will be. There's not a clear organized opposition. It's not clear that the internal security forces will be undermined by bombing. Most of the weapons the internal security forces use are rifles. So destroying buildings doesn't take 200,000 IRGC member and the internal security that report to them off the streets. So this is really hard. I would love to hear an explanation of what a stable outcome here is, because I'm not sure that there's a clear vision of what that stable outcome is.
Do you think the notion of bombing the borders, allowing Kurds to move in, and then somehow arming them or supporting them as a militia to fend off the Iranian security forces, is that reasonable?
You know, I read the stories this morning about that. I don't know what to make of them. There are a lot of ethnic groups in Iran. Choosing which ones to arm would be a pretty risky proposition to have confidence that you knew where it was going. This is not a novel problem. It was a problem in Syria. It's a problem in a lot of dictatorial states where there's not a well-organized opposition to jump in behind. So I don't think that this is unique, but when you go in with the goal of regime change, there ought to be some notion of what that leads to and what it means, and I don't see that. Look, the world is better off if Iran can't project power outside of Iran. But we're seeing the ramifications in terms of terrible losses of life, including American service members. We're seeing economic impacts that could be severe. It depends how long it goes, how deep it is. So all the experts who say they know where this goes, until you know where it ends, you don't know where it goes. So there's a huge price that you pay when you take on something like this. And I would be very happy if it succeeds. I'm not sitting here saying there can't be a better future.
That's the hard part to understand. I mean, that's what Senator Fetterman was saying. It's so hard to understand the Democrats' view that they can't have a nuclear weapon. The Iranian regime is terror, and they spread terror around the globe. But we can't support this war with
Look,
Trump.
Sarah, I was part of two administrations that made sure we had weaponry to destroy Iran's nuclear capability. I truly believe that when we developed the bunker-busting bombs in the Obama administration, that it was with a clear decision that we would not allow Iran to have a nuclear weapon. So I'm not going to sit here and say the United States should never strike against Iran. But you have to know what you're trying to do and how it's going to lead to a better outcome. And if it could lead, there's no likelihood here of a kind of democratic flower growing very quickly in Iran. The question is who's going to be in charge, where are they going, will they do more of the same or will they not? And I just don't know where this is going to settle out yet. So it's very hard without hearing a clearly articulated plan for the war. It's not really about their nuclear weapons. It may well be to reduce their medium-range missile capabilities. It may or may not be about regime change. And if it's about regime change, where does it go? The President of the United States has to tell us how we should understand this, and I don't think he's done that.
Jack Lew, really great to get your perspective. Thank you very much. Raising some important questions there. The former U.S. ambassador to Israel, former chief of staff to President Obama, and former Treasury Secretary. You've got a
lot of jobs.
Accolades.
Yeah.
Yeah. It's good to have you.
Good to be with you.
Meantime, Goldman Sachs raising their oil forecast as this conflict drags on. We'll talk about some of the scenarios in which they do see Brent going to 100 in a minute.
Goldman Sachs' co-head of commodities joins us next after raising their oil price forecast. And tomorrow, big exclusive in the 10 a.m. hour, we are joined by Paramount Skydance CEO David Ellison right here on Squawk on the Street. We're back in a moment.
Oil prices still in focus as the Iranian war disrupts production and exports through the Middle East. Goldman Sachs does raise their second quarter Brent forecast by about $10. They go to 76 a barrel, and by 9 for West Texas to 71. Joining us this morning, Don Stroyven, Goldman Sachs co-head of Global Commodities Research. Don, always good to have you. Thanks so much for helping us out today.
Thanks.
I got to say, the base case assumptions about recovery in the Strait are kind of encouraging. Would you agree?
Yes, but to your point, it's an assumption. To be clear, we expect in our base case the flows to the Strait of Hormuz to remain flat at current low levels. We are down about 85% from the peak. So at those levels for an initial 5 days. And then we assume a gradual recovery over the following 28 days. Under that assumption, our price forecast, base case price forecast, is not too dissimilar from the future. So in a way, the market is pricing a relatively quick normalization in the flows through the Strait of Hormuz, which, to state the obvious, are very large and essential for both for the oil and the LNG market. That said, I think the risks are skewed towards longer disruptions and therefore higher prices than our concerns.
And that's a longer disruption by a matter of a few weeks would introduce the possibility of Brent at 100, yes?
That's right. So we estimate that if you get an additional 5 weeks or so of very low volumes through the Strait, that prices could reach or exceed $100 per barrel, because inventory levels would fall to critically low levels, and the market would likely require prices to rise to levels that are associated with the demand destruction. I think one key point is that the impact on prices is very much a non-linear, a convex function of how long this lasts. And there's basically three stages. If it lasts a few days, you're essentially delaying exports. You're not really seeing significant production losses. If it lasts longer than a few days, because storage gets filled in the Middle East among some of the producers like Iraq, you get production cuts. And so you have permanent supply losses and permanent draws in inventories. And then the third phase is sort of this convexity phase where if you go beyond roughly 5 weeks, markets will likely require that prices rise more sharply to prevent inventories falling to below critically low levels. So the length of the disruption is the key variable to watch for energy markets.
Meantime, there are those who argue that because the economy is so resilient, or at least our own, and energy intensity has declined over the years, that you don't really see macro pain until, I don't know, sustained 125. Would you agree with that?
So it's clear the impact on the U.S. economy is clearly, a function of how long does this last and how high do prices go. Yes, the oil intensity of the global economy has trended down over time, but it's still the single most important price for headline inflation and therefore for real income. So, specifically, we estimate that every 10% increase in the oil price on a sustained basis reduces real incomes by consumers by about 0.3%, whether it's in the US or Europe. And Europe is extra vulnerable, not only because there's no partial offset from higher capex and higher profits in the oil sector, which the US shale complex benefits from, but also because Europe is also exposed to significantly higher natural gas prices, whereas the US natural gas sector is pretty immune. And on top of that, refined oil product prices in Europe are rising even more than in the US, because a lot of the imports are coming from the Middle East, are imported, and freight rates have also skyrocketed.
All right. Don, appreciate it very much. A lot of unanswered questions still, but that's some good guidance going in to the latter part of the week. Don Stuyven over at Goldman. We'll get more on the energy market and the war when we're joined by Carlyle's Jeff Curry when Money Movers begins in a couple of minutes.
Good Wednesday morning. Welcome to Money Movers. I'm Sarah Eisen with Carl Quintanilla live from Post 9 of the New York Stock Exchange. Today, after topping $78 a barrel this week, oil prices holding steady. Treasury Secretary Bessent this morning pledging support for the oil trade. But we're joined by one top energy strategist who says price shocks like this will have ripple effects across the entire economy.
Plus, the U.S. vowing to strike deeper into Iran as the now 5-day-old war spreads across the region. We'll talk about what it means for China specifically coming up.
And it's been blacklisted by the Pentagon, but Anthropic's reportedly now on track to generate almost $20 billion in revenue this year, up from $9 billion last year. Quite a jump. We'll dig into the numbers and talk about what's driving the explosive growth.
Meantime, even with all the headlines so far this week, S&P is roughly flat for the week to date. 68.78 is what you would need for that. We're barely there. NASDAQ has gone green for the week. VIX below, almost back to 20.5. And of course, the 10-year has come off of yesterday's 4.1.
Yeah, and oil prices are lower today. We're going to start with the latest in the Middle East and Washington. The defense secretary with an update on the fighting this morning. Eamon Javers in Washington joins us right now. Morning, Eamon.
Good morning, Sarah. The Pentagon said in a briefing this morning that the United States is winning the war against Iran. But Pete Hegseth cautioned that he didn't want to have a mission accomplished moment, referring to President Bush's premature declaration of success in the Iraq war in the early 2000s. Hegseth also said that the United States and Israel will have complete control of the skies in Iran in under a week.
Only the United States of America could lead this, only us. But when you add the Israeli Defense Forces, a devastatingly capable force, the combination is sheer destruction for our radical Islamist Iranian adversaries. They are toast, and they know it.
Meanwhile, on CNBC, Treasury Secretary Scott Bessent said the United States will use the U.S. Development Finance Corporation, known as DFC, to backstop the private insurance market for vessels in and out of the Persian Gulf.
We began yesterday with the announcement that DFC will provide the insurance for both the crude carriers and the cargo ships operating in and around the Gulf over the weekend. Lloyd's of London nullified the insurance, so U.S. government is going to step in, and when it is appropriate and should it be needed, the U.S. Navy will provide safe passage through the straits for the oil tankers.
Bessent also said that the global crude oil market is well supplied, and he promised a series of announcements from the administration designed to keep that supply flowing smoothly. Guys, back over to you.
What do we expect from the White House, Eamon, on this vote in the Senate? You know, they're voting on whether to give him the power, I guess, to continue to pursue the war.
Yeah,
what's the expectation, and how's the White House handling it?
Well, we'll see what happens up on Capitol Hill. The White House clearly doesn't believe that they need congressional approval to conduct this war. What Secretary Rubio has said up on Capitol Hill throughout the week is that they notified Congress, they notified the so-called Gang of Eight top leadership up on Capitol Hill, and they did everything they were required to do under the law. You know, the president is taking a very maximalist position here on U.S. authority and presidential authority. Yesterday, he talked about the Spanish government declining to allow the United States to use bases there. The president said, look, we don't need the Spanish permission. We'll just fly out of their bases anyway, whatever they do. But ultimately, this is a president who is looking to flex both U.S. and presidential authority domestically and U.S. authority globally. So I think that the vote up on Capitol Hill, you know, is important, is symbolic, but for the most part, this operation is going forward, and it's going to continue to go forward.
Finally, Eamon, on DFC, Evercore did a note yesterday where they argued it's probably not sufficient to get flows coming back. These things need approvals, and it's hard to tell a crew, hey, you have to go through this lane where there could be mines, there could be drones, but you're insured.
Yeah. I mean, the question is, can the U.S. government provide enough security with the U.S. Navy and with this insurance backstop to convince private carriers to begin to go through and run that gauntlet, as you say? And that's sort of an unknown right now. And we heard Bessent this morning saying that the United States is going to offer other announcements. We don't know what those are, but presumably other items in the government's power to kind of induce oil shipments to continue. One of the questions I have about all this is that, a lot of the oil leaving that region is heading for China. And so do you have an unusual situation where the U.S. Navy will be providing security for oil for China? That's a fascinating geopolitical twist that a lot of us didn't see coming.
Yeah. Meantime, Maersk is on the tape saying temporarily suspending cargo bookings in and out of the UAE, Oman, Iraq, Kuwait, a bunch of others until further notice. Eamon, thanks. Eamon Javers. Meantime, the major indices, though, looking to stage a rebound from yesterday's volatility, but the conflict is still weighing on Asian markets in particular. The Kospi in South Korea, the worst day ever. The Nikkei and the Hang Seng both under pressure as well. Joining us this morning at Post 9 is Deutsche Bank Chief U.S. Equity and Global Strategist Venki Chadha. It's great to have you back, Venki. Interesting dichotomy overnight between what did happen in Asia and then what happened in Europe. Is that just a function of where valuations had been in Asia?
I think what we're seeing basically is the S&P 500 range basically continues to maintain. The range began basically back in December. Latest developments, what you're seeing is sort of broad-based, reduction in positioning across asset classes, whether you're talking gold, and so, you have this swapping of the winners and the losers. You've seen the bounce in software, the alt firms for a little while. And the market's basically been long the rest of the world relative to the U.S. I think, it's interesting when you brought up Korea. So Korea is very memory related. So that's tied into sub-parts of the U.S. market is the way that I would put it. And then you have the double whammy of the market was short the U.S. dollar, so the U.S. dollar rallies as part of the same risk reduction, and that's a double whammy basically. But I would put that second on the Korean market basically.
So do you see this as just a short-term move to sort of unwind some built-up positions, or something longer fundamentally changing?
I think that basically what's been going on for a little while, even before these events, is the market has been moving towards neutral in a lot of places. Where the positions were open and long is really the rest of the world relative to the U.S. And that, I think, continues. But what I would say is, while we've been sitting in this range, we're growing earnings at an annual rate of close to 15%. So stocks are a little bit cheaper after 3 months. I would say if you look at, growth, both ISM manufacturing, ISM services looks pretty good. So, we are constructive 3 months and out, but I think it would be the biggest irony if these events leads us to break the 3-month range to the other side. But that's because stocks are a little cheaper and growth is a little bit better. The inflation scare coming out of the goods side and manufacturing. We have the reverse this morning with services. So it looks pretty good from a fundamental
Can the market handle fewer cuts or no cuts?
Yeah, I think there's very little priced in. And now market pricing is pretty close to our house call for one more cut this year. And so I think, whether it's one or it's two, I don't think makes a material difference. I think the real issue is just really earnings and whether they hold up. And we think they do.
Do you buy into the oil shock inflation scare narrative that this changes things for the consumer?
Not particularly. First of all, the move hasn't been, that horrendous, number one. Number two, the trend of oil usage, whether you look at it as GDP or inflation, has been, trending down. So it becomes less and less important. So, China, is arguably the least exposed. We keep discussing Chinese oil, and that's very important as a ratio and the share of their imports, but their overall usage relative to their level of activity is pretty low. And so, the global economy is just using a lot less oil, and that's an ongoing trend, so we've become less and less vulnerable to the shocks. And the shock just really has not been that big yet. If you think about, do it in terms of WTI, as of Monday morning, from the December low, oil prices were up 33%. But 2/3 of that, 22%, happened prior Friday before the shock hit. So, the Monday morning response was partly most of this already happened. So what is the surprise here? I mean, it's there, but it's smaller than the level indicates, basically, incremental.
You mentioned the alts in passing, but where is the private credit discussion right now and the worries about default rates in software and whatever else?
What I would say is, on the software side, we had a piece out last week looking again at positioning. I'm sorry to harp on positioning again and again, but if you look at the shorts in software, I mean, they were the biggest since the global financial crisis. I mean, and we don't need that reminder for existentialist crises. But we do believe as a house, and our company analysts believe it's overdone. I think this all sort of plays out over time if it happens. And what I think the narrative misses is companies adjust, companies respond. I think as somebody said, it wasn't me on this show here, when asked, remember the second half of the 1990s when the internet was going to put all banks out of business? I'm still working at a bank. I think, the whole tech rotation story, if you put it in perspective, it's sort of the NASDAQ peaks in October. And basically starts to go sideways. But did it peak because of concerns about tech and software, or did it peak because Q3 earnings showed very, very clear signs of broadening out, and the broadening went further than in Q4? I think a lot of that initial move was just simply short covering. There's possible life outside, basically, mega cap growth in tech. And so when you're 3 months or 2.5 months basically into that rotation, you're going to be a lot more sensitive to bad news on what you're selling. And so, it's a time when things are going to get exaggerated. So I do think that, shorts are a risk too in anybody's portfolio. So not every move is fundamental.
Yes.
Yeah.
We'll come back and we'll talk large versus small and value versus growth. Always good to have you, Binky. Thank you.
Thank you.
Binky Chadha.
Thank you.
If you keep your job. Don't jinx it. Still ahead, what the war in Iran means for China. The Treasury Secretary weighing in on the energy impact on our air earlier this morning. We're going to hear those comments next.
Then some new reports say OpenAI challenging one of Microsoft's most valuable businesses. The latest example of a company that Microsoft funded that's now coming for its core product in a minute.
China is very vulnerable on the energy side. More than 50% of their energy comes out of the Gulf. They've probably been buying 95% of the Iranian crude. That's obviously on hold right now.
Treasury Secretary Bessent on our show this morning talking about China's exposure to Iranian oil exports, now threatened due to this ongoing conflict in the Middle East. For more on what the war means for China, we are joined by Mary Kissel, Senior Policy Advisor at Stevens. Mary was also a Senior Advisor to Secretary of State Mike Pompeo during the first Trump administration. It's great to have you back, Mary. So the China question, what is the message here for China?
It's great to be back with you, Sarah. I think there are multiple lessons here for the Chinese regime. The first is that U.S. deterrence has obviously been reestablished and reestablished with force. Trump means what he says. If he says he's going to act, he's going to do it. That in and of itself, I think, makes all Americans safer. Secondly, I think the power of our alliance structures has become increasingly clear. Recall that China has done a lot to try to put divides in between us and our Saudi friendship, our alliances in the Gulf. They've done joint naval exercises with the likes of Oman. They've sold technological products to Saudi Arabia, et cetera. But now they see those allies coming together with us to face a common threat. So they wouldn't like that very much. But third, they've now seen us engage in weeks-long military buildups off the coast of Venezuela and then in the Middle East for these two actions. And if I were sitting in Beijing, I'd say, gosh, if I want to do something like this, if I want to, take some Philippine territory or invade Taiwan, I'm going to have to disrupt the United States in their homeland, which of course they do have the capability to do. So I think one of the messages that we're not talking about is that it's very, very urgent for the U.S. Congress and for the private sector here in the United States to harden that infrastructure, telecommunications infrastructure, utilities infrastructure, et cetera.
You're talking about what? The risk of cyber attacks from China?
I think we've talked before on this program about the Salt Typhoon and the Volt Typhoon hacks, which have enabled the Chinese to read our text messages, listen to our phone calls. They're burrowed into our critical infrastructure. They've bought land around U.S. military bases. There's just a whole variety of measures that we need to get more serious about. And I think that's something that the president might raise with Xi Jinping when he meets him at the end of this month.
It's interesting because some argue that they would say, passive stance regarding Ukraine, Russia sends a signal to China that they can go and do whatever they want.
What passive stance?
Well, the notion that it's been 4 years and we haven't ended the war on day one. We haven't really leaned on any aggressive way to get the peace talks resolved.
Well, you just had Jack Liu on your program, who, of course, gave billions of dollars to Iran under the Obama administration. Obama gave them only defensive weapons. In Trump 1, of course, we started to give them offensive capabilities. We also imposed sanctions on Putin and his inner circle. We withdrew from the INF treaty. We kicked their spies out. We punished them when they used chemical weapons. The president has only increased the amount of support that we've given Ukraine in terms of, intelligence surveillance capabilities. That's enabled them to use their weapons to go behind Russian enemy lines. Actually, he's done more, I think, than any prior administration has done. It's true that that war is not complete, but there's another lesson here that I think is important that Secretary Bessent just highlighted a little obliquely, which is that, we talk about these conflicts as if they're bilateral concerns, but they're not. And what we tell clients is, look, you got to see the world the way that it is. And so this is not a U.S.-Israeli action on Iran. Iran's partners are China, Russia, North Korea, Pakistan. That's the conflict that we're seeing, and we're seeing alliance structures change. The Europeans had really given us absolutely no assistance, and other longtime partners like Canada and Australia in this conflict. But the folks with whom we share our strategic interests, the ones that are closest to Iran, are in the fight with us. That's a good thing. And I think that, as these alliance structures change, whoever's watching your program, be it investors, C-suites, others that care about these things, they're invested, they need to recognize how these structures are changing, because I think these are permanent changes. I don't think that They're just coming together for this moment.
Do you think there's a collision between not just the national security strategy memo, but the argument we've been making that everyone needs to be more self-sufficient, and then we turn around and complain that you're not with us in this fight?
I'm sorry, our relationship with our partners is very, very complex. So take, for example, our relationship with the United Kingdom. I think, because they've said, well, you can't use our bases for offensive means, you can't conclude that that relationship is broken. We are deeply integrated in terms of trade, culturally, diplomatically. They do a lot for us in international institutions. So, I think it's tempting to say, gosh, this one action, we've had a dispute or a disagreement with an ally, the entire relationship is broken, but that's just not reality in how the world works.
So what are you telling your clients, Mary, ultimately about how this ends?
Well, that's the question. Certainly degrading Iran's offensive capabilities by destroying their nuclear program, their ballistic missile program, their Navy, brings more stability to the region because it means that Iran cannot project power to its near, abroad, and beyond. And so that's a good thing. But ultimately, we're going to need to see how this shakes out. Iran is not a single ethnicity, right? You've got Kurdish parts, Persian parts, Azeris, Baluchis. You could very well see a fractured Iran. But I think, another question mark here is, what will the Gulf states and Saudi Arabia and the likes of Oman, what role will they play here? It's in their interest to see peace and stability in the region. Could we get a free and democratic Iran? I think everybody would love to see that. I don't know what the likelihood of that is. It could happen. But in the near term, simply by degrading those capabilities, you've brought a lot more stability to the region than we had only a week ago.
I was going to say, does it make you more bullish on things like tourism in Saudi Arabia, which they've been investing billions of dollars in? Not to mention what you can contemplate what the future looks like for Iran.
Well, think about the amount of capital that we've seen flow into the Gulf region and flow out of the Gulf region into the United States, into some of our major companies here. They're a great partner for us. It's sources of long-term capital. I mean, you've seen all of the bulge bracket bank CEOs flying over to Riyadh for a reason, because they want that capital. And so, if we could get to a point where the Iranian people are determining their future, where we have completely degraded this threat from the world's largest state sponsor of terrorism, where Saudi Arabia would join the Abraham Accords, that'd be a pretty great place to end up.
Mary Kissel, great to hear from you. Thank you very much for your time today.
Thanks for having me.
From Stevens, former advisor to Secretary of State. Up next, new reporting and the comments from the CEO of Bath & Body Works. The stock now well off its pre-market highs, but still up about 4%. We'll have more on that after the break.
Carlisle's Jeff Curry's with us, how the war in Iran is impacting energy prices and why he says the ripple effect through the economy will be felt in places many don't expect. In a moment.
Welcome back. Bath & Body Works higher this morning after earnings and revenue did beat estimates. I spoke this morning with the new CEO, Daniel Heath. He's been there about 6 months. On the quarter, he did say we beat our expectations that we laid out, but we're miles below our expectations for the brand. As far as what they saw over the holiday, after the shutdown, he said our business really picked up. At key holiday moments, we offered amazing discounts and we won. The results come as Heath is working on this turnaround plan. But he says part of the solution here is to not do those discounts. I mean, he spent the first few months of his tenure really diving in and trying to diagnose the problem, and then now laying out the solution, which he says is creative disruption and innovative products to reignite the brand. Also, he says winning in the marketplace beyond the store. They've always only sold in their own stores. Well, guess what? Now he has launched mid-February in Amazon. Says it's too early to discuss results there. And then lastly, speed and efficiency, streamlining decisions. He says the most important shift is from a specialty retailer to being a global brand. It will take time, he said, but we're moving at real pace. When it comes to guidance, that was disappointing, and they're still projecting lower sales. But he said on that, they're not going to use increased promotions to drive growth in 2026. He also said they're in the early stages here. Things are happening. People can't see it yet, but he does expect it will ramp week over week and quarter after quarter. Here's the problem with Bath & Body Works. I grew up going to Bath & Body Works. It's very nostalgic for me. It's a mall store, but the brand, I mean, they expanded into so many places, into laundry detergent, and they just did not. You know, they sort of missed the big beauty trend that was happening at Ulta and Sephora. It's a really strong category, but it's not a brand that young kids, your daughters necessarily might identify with, and that's what he's trying to work on. I mean, you'll see influencers, you'll see them going on Amazon into other places outside the mall, and it's a really interesting case study of a brand new CEO. He came from Nike, Daniel Heath, trying to reinvigorate a brand. It's like the conversation I had with Target yesterday and the new CEO, or what's going on at Nike. You know, this new leadership and whether they can get these brands back to growth and relevance again. Yeah. And a lot of interesting case studies out there right now.
It's hard to do. By the way, Target upgraded by Dana Telsey today, adding to some gains after yesterday's.
That's
30% in 6 months.
Yeah, I mean, so it's outperformed this year, but still, from a valuation perspective, if you look at it compared to where it has been and where certainly competitors like Walmart are, I think Target executive management feels like there's a lot of white space, but the numbers and the outlook and the projection for growth was better. And I think incrementally, a lot of the analysts felt that there was a plan and that there was some new energy and some changes happening at Target, both to make the stores feel better and look better and the experience better, and also get the product assortment right. And that's something Fidelki told me he's really focused on.
Still, the best looking retail charts are Walmart,
for sure,
Ross Stores, and TJX, which says a lot about what the consumer is thinking right now.
Of course, and Target used to dominate, the home goods section, right? But TJX, it's home goods. They've taken a lot of share, so it's a different competitive landscape. Not to mention what Walmart's been doing, dominating on grocery and staples.
Holding these gains here, S&P up 50. Let's get a news update with Angelica Peebles, who's back. Hey, Angelica.
Hey, Carl. Well, it's great to see you. The House Ethics Committee announced today that Texas Republican Tony Gonzalez is under investigation for an alleged affair with a staffer who later killed herself. Gonzalez is currently facing a runoff election after failing to win a majority in yesterday's primary. He's denied the affair and has refused to step down. Federal prosecutors told a Brooklyn court late yesterday that they plan to extend plea agreements to 12 of the defendants charged in an alleged nationwide rigged poker ring. NBA Hall of Famer Chauncey Billups is among those charged, but it's unclear whether he has been offered a plea deal. He has been on leave as coach of the Portland Trail Blazers since November when he was arrested, and he pleaded not guilty. Democratic lawmakers are reportedly working on a proposal that could lead to the breakup of U.S. meatpacking companies. That's according to the Wall Street Journal, which reports that Senate Minority Leader Chuck Schumer is preparing legislation that would prohibit companies from processing more than one kind of meat and calls for a review of foreign-owned meat companies. Carl, back over to you.
All right, Angelica, good to have you back. Angelica Peebles. After this, could some of Microsoft's outside AI investments end up cannibalizing its existing business? We'll look at that in a moment. Plus, new CNBC reporting detailing Anthropic's growing revenue numbers as its standoff with the Pentagon drags on. NVIDIA's Jensen Huang, Microsoft's Satya Nadella, both set to speak at the Morgan Stanley TMT conference today as investors look for some answers around all this recent AI trade uncertainty. Deirdre Bose is live there from the conference in San Francisco and has today's Tech Check. Morning, Dee.
Hey, good morning, Carl. So Satya Nadella in particular, he is walking into what may be one of the most uncomfortable investor interviews of his tenure. Microsoft stock is down more than 15% this year, the worst performing of the Magnificent Seven basket. Its early lead in the AI race, it has run out of fuel, and increasingly the very companies that it's invested in are coming for its most valuable businesses. The latest reported by The Information just yesterday, OpenAI is building a competitor to GitHub. That's Microsoft's platform where developers write and share code. Now, OpenAI may have seen an opening to move in because GitHub kept going down. Outages that GitHub itself apparently blamed on Microsoft's own Azure cloud. So Microsoft's infrastructure essentially pushed its biggest AI partner to build a rival product. Now, of course, it's not just OpenAI. Anthropic over the last few months has launched Claude directly in Excel, Claude directly in PowerPoint, coworkers replacing industries. And that gets to the existential question hanging over really every software company right now. And that is, if AI can do the work, do you still need the software? The market is clearly still working through this question. Now, Microsoft may actually be the more exposed than people think, because unlike a Google, which has search and advertising to fall back on, Microsoft is at its core a software licensing company. And its answer to this threat, Copilot, just hasn't delivered. So we haven't heard from CEO Satya Nadella either in a while. The bravado he had in the early days of the AI race, remember when he said that he would make Google dance? That is now being overshadowed by the math. Microsoft could spend $200 billion in CapEx in fiscal 2027, gross margins hitting a 3-year low last quarter, and nearly half of its more than $600 billion backlog is tied to OpenAI, the same company now building products that it competes with. So essentially, guys, Microsoft is bankrolling its own disruption. Nadella is on just behind me. Less than an hour from now, we'll be watching, and he's going to have to make a strong case to investors.
What would he say to all that?
He would say that they were early to AI, like you hear a lot of all the software CEOs say, that we're not going to be disrupted because we're partnering, we're integrating these tools. He's probably going to urge more caution for Copilot, say that there's 15 million paying users, but it's just not showing up in the math, right? So you can say all of that, you can say that you're well positioned, and it was very early on, but maybe the biggest sort of point that he's been saying for the last 3 years is that partnership with OpenAI, it's now becoming a rivalry. And even though it's investing in Anthropic, it's diversifying. Some of the tools that Anthropic is putting out are threatening too. And, Dario Amodei was here speaking last night as well.
Okay, Deirdre, thank you. Deirdre Bosa. Speaking of, let's turn to Anthropic. Some new reporting surrounding its growing revenue numbers. Kate Rooney joins us now. My biggest question, Kate, is this before or after the fight with the Pentagon?
Right before, Sarah. These are sort of current numbers as of the last couple of weeks here, but really during, and you mentioned that face-off with the Pentagon. While that was happening, its AI business has been booming behind the scenes, at least from what we're hearing. I am now hearing that Anthropic's annual revenue run rate, ARR, has topped $19 billion. It's nearing $20 billion. This is according to a source familiar with that company's financials. It's based on current performance, Sarah. So as you mentioned, during all of this back and forth with the Pentagon, up from $10 billion just at the end of last year. You look at a month ago, the run rate was $14 billion. When Anthropic closed its latest funding round, that valued the company at $380 billion. Anthropic's still not profitable. I'm told it's still losing billions per year. A source also telling me the revenue momentum is largely thanks to the success of Claude Code. So before the Pentagon spat, this was only a couple of weeks ago, the buzz around Anthropic was really around its coding capabilities. The improving features were one of the big factors spooking software investors and threatening their business models. Anthropic's momentum also really speaks to what's at risk here. With that Pentagon fight, the growth is under threat as the Pentagon now labels the company as a supply chain risk. We are seeing some defense companies dropping Claude after the Pentagon's announcement. Reuters now reporting that Lockheed Martin is expected to remove Anthropic's technology from its supply chain. CNBC.com has another look today at startups doing the same out of an abundance of caution. I am hearing similar themes for investors and CEOs in Silicon Valley. Their startups are now looking for alternatives, and many really built their companies, their startups, entirely on Claude, on that technology. The president also directed all government agencies to stop using Claude with a sort of 6-month ramp-off period. But for now, I am told by a source, U.S. military is still using Claude for operations in Iran, guys.
Although we continue to see reports, Kate, that it has been extracted from, say, Treasury, from Department of State, some other agencies, right?
Yeah, and it's entangled in a lot of these. I've talked to sources who say it's going to be a long time before they can sort of figure out how to replace Anthropic. That may be OpenAI, based on them signing sort of a new government contract on Friday. But it can be tough to sort of, unwind some of this technology once it's really integrated with whether it's the government or an enterprise. I mentioned the sort of growth threat as we talk about that supply chain risk. A lot of these companies have been entirely built on top of Claude. You talk about sort of these wrapper AI startups that really are powered by AI. Claude has been seen as sort of the go-to for a lot of startups. So you have the government needing to unwind, potentially startups, potentially enterprises, and I think we're going to see long-term effects if that supply chain risk designation does actually stick.
Yeah, contract big, not just startups. Lockheed Martin reportedly too was told to get it off the systems. I mean, enterprise has been the bread and butter for this company. I wonder how big this spillover effect goes.
80% of revenue for this company, so it's largely a B2B company. They are going to fight this in court at some point. They've talked about pushing back and saying, we will go and fight it, but the chilling effect from investors that I've been talking to is sort of what happens in the in-between. That growth rate we just talked about and the revenue run rate is massive, but it is completely reliant on enterprises. So there's startups, there's government contracts, you also have big tech, you have Amazon is a big backer of Anthropic, Google. So these sort of uncertainty in the middle of, yes, you might not be able to use these for government contracts or supply chain work, but what does that mean for things in the interim? And is there a headline effect of, if the administration is sort of seen as an enemy of Anthropic, it could cause a lot of issues.
Okay, Kate, thank you. Kate Rooney. When we come back,
guys.
Carlisle's Jeff Curry on the energy markets. Could insurance guarantees for maritime trade help ease prices? New reports out of Iran's secret outreach possibly having an impact as well. We're going to talk about all the moving parts here.
Plus, do not miss Berkshire's new CEO, Greg Abel, an exclusive on Squawk tomorrow at 7 a.m. Eastern Time. Money Movers back in a minute.
Welcome back. Oil prices lower today for the first session since the U.S. launched its war against Iran. That's as U.S. Treasury Secretary Scott Bessent said the administration will provide support to oil tankers in the Persian Gulf and will announce more measures in the coming days. Joining us now is Carlyle Chief Strategy Officer of Energy Pathways, Jeff Curry. Are you surprised, Jeff, at the response we've seen in oil prices right now? I mean, a lot of people expected it would look a lot worse if the U.S. was waging war on Iran, a major producer.
Well, I think the fundamental situation looks a lot worse than what most people anticipated, but the complacency of the market just doesn't make sense. And I want to just go to one observation. Polymarket puts the probability of regime change at 16% at the end of this month. So that's 4 weeks. The straits are shut right now. That's 20 million barrels a day. At most, that oil glut, at most is, 250, maybe 300 million barrels out there. You're going to burn through that in very short order. Yes, there's a statement that the U.S. is going to help, protect any convoys going through the strait, but even the military has questioned the capability of that being executed upon. It's very tight. It's quite dangerous right now. So I'm a little confused how one market is pricing this thing is going to go on. And also another thing to keep in mind, it's not just what's happening in the Gulf. I think the asymmetric warfare doctrine of Iran suggests they have proxies that can be anywhere. Another point here, too, is you're shutting down oil in Iraq right now. And when you shut down wells, you potentially do damage, and the ability to get them right back up very quickly is questionable. So I am surprised, let's say, but in terms of thinking about what the market's pricing right now is kind of like a scarcity premium, meaning we're going to run down that glut. What we haven't priced in is a security premium, meaning I need a hoard. I need to hold more level of inventory given the uncertainty in the environment.
Yeah, I am curious, Jeff, where you think the locus of that pain is going to be. We're looking at reports today about potential gas rationing in India. Obviously, parts of Asia they're in a pickle here, are they not?
Oh, absolutely. The consuming nations are in a very difficult situation, and I would say Europe is in the most difficult. I like to think about the world as U.S. bloc and China bloc. China bloc has access to Russian oil and the sanctioned barrels. Yeah, you're right, India is lesser, but I think at this point, if they have to start rationing, they're going to look for those Russian barrels. But I think the point with Europe is they're not like the United States. They're not long oil or energy more broadly. They're short, and they have two choke points. They've got one through the Hormuz Straits, and they have one through the Red Sea. And that's part of the reason why TTF, the gas prices in Europe, have been so explosive. Now, then you gave a list of different energy products. Let's throw in fertilizers in there, plastics. The list goes on and on. And I think the market is not factored. The market is saying this thing is done, in a very short order, and the convoys will pick up. But you have to ask your question: what if we're wrong on that? And I go back to the poly market. The poly market saying, more likely than not, this is going to take a lot longer. So I think the market's mispriced, and there's more upside here.
Okay, Jeff, thank you for joining us with your take on that and why you think the market's wrong. Jeff Curry from Carlyle. By the way, on all of this, don't miss an interview tomorrow on this show with Steve Witkoff, Special Envoy to the Middle East. He was directly involved in those Iranian negotiations that precipitated ultimately this. He's been warning that they were not negotiating in good faith. We'll talk to him about what comes next. That's tomorrow on Money Movers.
When we come back, could unusual activity among workers with 401ks be a flashing sign, warning sign for the economy? Some of these hardship withdrawals. We'll get to that on the other side of this break. Welcome back. Could record 401k withdrawals be signaling some trouble for the economy ahead? Our senior personal finance correspondent, Sharon Epperson, watching some of these numbers out of Vanguard. Sharon, eye-opening.
Definitely. You know, more savers have been taking money out of their 401ks, even as average account balances have seen double-digit gains. New Vanguard data shows that the share of participants tapping their 401k reached a record high in 2025, with 6% taking a hardship withdrawal. That's up from 4.8% in 2024. Now, for retirement provider Alight Solutions, the percentage of 401k participants taking hardship withdrawals nearly doubled from February 1st, 2025 to January 1st to January 31st, 2026, rising to 3.8% during that period from about 1.5% the year before. Now, with a 401k loan, you borrow that money and pay it back with interest. A hardship withdrawal is different. It's a permanent distribution that the IRS says must be for a, quote, immediate and heavy financial need, and it's taxed. There's several factors that are driving workers to take these withdrawals, experts say, with increasing debt loads, including medical expenses, as well as ongoing affordability and financial pressures. A regulatory change under Secure 2.0 also makes it easier to qualify, since participants can self-certify that they meet this hardship criteria. Now, separately, the law allows for one penalty-free withdrawal of up to $1,000 for emergency expenses each calendar year, and you have up to 3 years to repay that. The typical hardship withdrawal is relatively small as well. For Vanguard participants in 2025, the median withdrawal was $1,900. Still, experts say the increase in withdrawals highlights the need for financial wellness and emergency savings resources for workers. Check out my Money 101 newsletter for alternatives to tapping your 401k to cover unexpected expenses. Use the QR code right there on the screen or go to cnbc.com/money101. Back to you.
Sharon, 6% versus, I think, pre-pandemic, the average was around 2%. That's a big difference. The other thing, it kind of fits with what's happened to the saving rate, which is obviously at a multi-year low.
But we are seeing, though, more people automatically enrolled in their 401ks, and then they are saving more. Some of them are saving more with that automatic enrollment. So that and the fact that the market gains that we've seen over the past year have pushed up those balances, we're looking at workers seeing account balances that are up as much as 17% or so, going from, Alight Solutions says, $142,000 on average to $167,000 on average a year later. And so that type of change is creating an opportunity for people to have more in their nest egg to take money from. The problem is they're not doing the emergency savings, so they're tapping all that they have as a resource, and that happens to be that retirement money. That's the problem, and that's why many are saying there needs to be more financial wellness and more savings accounts that are emergency savings accounts offered by employers, which many more employers are starting to look into.
Okay, Sharon, thank you.
Sure.
Sharon Epperson, good update on 401k situation. Quick programming note, I will be speaking with Salesforce CEO Mark Benioff tonight on Fast Money, 5 p.m. Eastern. The stock has been at the center of the software sell-off storm, you know, on fears about growing adoption of AI and what it will mean for these key players in the software space. So looking forward to that conversation. And then a lot of good ones here on the show tomorrow. Steve Witkoff, President Trump's special envoy to the Middle East. Of course, David Ellison, Paramount, fresh off winning the bidding war for Warner Brothers Discovery. It's going to be a lot of good guests tomorrow on the show.
Yeah, we'll get some earnings to look at tonight. I think Okta's on the tape. As for the markets right now, trying to hold those levels that would put you flat for the week, around 68, 78. We're a couple points shy, although the NDX has gone green for the past few days.
It has been tremendous resilience in the U.S. equity market to some of the uncertainty around geopolitics and this war. The U.S. continues to climb this wall of worry.
Yeah. Let's get to the judge at Post 9.
All right, guys, thanks so much. Welcome to the Halftime Report. I'm Scott Wapner, front and center this hour. Stocks looking to bounce back today following 3 days of selling. We're trading the markets, keeping our eyes on developments, of course, in the Middle East. And joining me for the hour today, Joe Terranova, Liz Thomas, Bill Baruch, and Steve Weiss. I'll show you what we're doing here at 12 noon in the East. We do have a pretty good bounce back on the tape today. In fact, NASDAQ week to date, positive. The Russell's now positive. The S&P barely negative, as is the Dow. So ADP, Joe, was better than expected. You've got a bounce in some of the private credit names. That is definitely helping sentiment. Oil's lower. Yields continue to move up, but only modestly. Yep. You do have Goldman today suggesting that equities are still vulnerable to a correction, not a bear market, however. And Deutsche thinks that equities are close to the trough. Do you agree with those assessments?
I agree with Goldman. I like that. I think we are vulnerable to a correction, not to a bear market. I think a lot of people are looking for this to be the bottom this week. In fact, if it is the bottom, what do you need to see that? First of all, you have extreme volatility and you have an outside standard deviation move. That actually conforms to the needed ingredients for a bottoming process. Why? Because in that type of environment, what you will see is that leverage comes down and position sizing comes down. And you need to have that if, in fact, ultimately you are going to be bottoming. So I think you could be encouraged by that. I think you take the bear market scenario completely off the table. I don't think that's unfolding. I think we saw the places where you wanted to see the safe haven element present itself, like the Mag 7. I think that was valuable. You're seeing cryptos bouncing. I think it's up about 6% today. So you have the buildings of a bottoming process. Let's see where we go from here.
Yeah, you got a lot of stuff that's in the green. So Liz, Wolf is looking at some of the technical points within the market, pressure points. 6780 support level, as they talk about the bulls defending that. And Joe said, well, what might we need to see happen to declare that we have troughed, that we have hit a bottom? I mean, they talk about, they're wondering whether we need to go lower than 6,500 to sort of reset everything. Yeah, I don't know, but you don't have to opine necessarily on the technicals, but it just shows you from the Goldman note, from the Deutsche note, that people are looking at what's happened here, and it does speak to the word that Sarah Eisen used at the end of the last hour, and that's resiliency of this market.
So every technician that I follow has said something in that 6,500-ish range is where the next level of really big support lies, and that's why we continue to hear about it. We may need to get there. The other word that people talk about a lot is capitulation. Have we seen true capitulation? And there are a lot of different ways to measure that. Here's how I would measure it. If you just take a rule of thumb, what you want to see to really say, all right, the flush has happened, we've washed it all out, is that things like volatility have risen, and that it's also risen along with correlation. We saw yesterday,
at least at the open, right?
In the beginning of the day, the first half of the day, we saw correlations rise, and what I mean by that is all the stuff went out. You couldn't hide anywhere. Everybody was selling everything, including the good stuff, including defensives. So we've seen at least a brief period of correlations and volatility rising. Perhaps that was the washout. We do need to see de-escalation in the tension in the Middle East in order to really feel like it's done. I'm not convinced that it's done yet, but I agree we don't need to get to a bear market. And if we're talking about bear market, that's obviously beyond 20% drawdown. Drawdowns absent a recession typically fall somewhere in the 15 to 25% range. Drawdowns with a recession are usually beyond 25%. We are nowhere near any of that. So I say that to say we could be in a position where maybe we're not quite done with the pullback yet, but I don't think this is headed for anything disastrous.
You may still have a bit of a chaotic aftermath in and around Iran, but as the days progress, if not even by the hour, its ability to strike back at certain targets is being decimated sort of piece by piece. So you have to, I think, keep that into perspective as you listen to officials in Washington give the updates on what's actually happening over there. Wondering where you think we are. Are we in the Goldman camp that we're still vulnerable to a correction? I guess you could always say we are, but we're not going to have a bear market. And as Deutsche suggests, we are close to a trough.
Yeah, I agree. We're in the trough, and I think there's less chance of a more correction than there was last week. I think this is a very good scenario. Keying off what Joe and Liz said, we saw a washout, we saw leveraging come down, and you're able to really kind of rally out of that the way we did yesterday. I think is positive. Today's positive. Talking about Iran, oil prices are coming off a little bit. Now, the thing that I really like within all of this is you're seeing a rotation. I mean, your staples are down again for the third or fourth day in a row. You're seeing tech come out of that. We're seeing, to me, me, those are risk-on thrusts here that I think are very, very well in pointing us that direction higher. So if we continue to get the flows that I expect, we could be really on our path to see all-time highs. Now, we do have to get through this area where we're trading right now. This is where we closed on Monday in the S&P 500, and we have to clear that gap. Today's close really going to be paramount in setting the tone for the back half of the week.
I'm glad you mentioned all-time highs. Some hear those words and think to themselves, that sounds ludicrous, until you look at the fact that you're literally 1 3/4% only off of the 52-week high, the all-time high for the S&P 500. Okay, so that's good perspective to have. Weiss, if you look at where the money's going, where the flows are showing, out of small caps into large caps, that's been the story. Wolf suggests it's going to continue to play out. Bank of America's client flows do as well. Net buyers, they say, of U.S. equities were their clients, driven by single stock inflows, driven by institutions, the biggest inflows since late November. That followed 2 weeks of selling. Large caps were the only size segment to see inflows. When in doubt, go big or go home. Right?
Agree with that, and that's what's been happening. That's why I haven't changed my position. But I just want to address what everybody said and the notes. You really have to take a step back. Now, we saw some scary things in the headlines this week, of course, but when you take a look at the indices, the broad indices, they barely moved. You're down a couple of percent. There's no correction. There's no panic. There's no place to capitulate because you haven't been down far enough.
In fairness, yesterday morning,
I'm talking about where they closed.
And Mike Santoli had cited, it felt a lot like that because it was messy. It felt terrible, and people were wondering how low it may go on that first open after the warhead began, and we just didn't get it.
You're absolutely right. The intraday, particularly the overnight trading, that was panic trading. But once the market opened, then you saw the market recover nicely, and we're basically no more volatility than what we've seen over the last year. So I think we're in pretty good shape here. In terms of the war, look, you can always make a case for why this is different, but the market's actually very smart about it. If you go back during my career, your career, to anybody in this desk, you'd recall there was always panic when the Mideast flare-up happened. And then 2 days later, you'd say, what was that about? It was a buying opportunity. Geopolitical risk is always a buying opportunity.
Well, that's why Jonathan Krinsky puts a note out in the last 48 hours, when the missiles fly, these are his words, not mine, when the missiles fly, it's time to buy.
Exactly. But if you take a look at one sector that actually corrected was financials. And that was part what's happening in the Middle East and part, as you point out, private credit. So I don't think the private credit issues have gone away, but nor do I think they're as significant as the headline stated. So you're always looking for opportunities to buy. For me, I look at those as opportunities to buy, but, I'm buying more of what I own, and we'll get to it later.
Well, we can get to it now because it speaks to exactly what I said about money coming out of small caps and going into the biggest stocks within the market. If you look at the way that the mega caps have traded, it's right back to that safe haven, dare I say, status that many of them had before you started to get all the massive spending on AI and then some of the fears. Both of you guys sitting next to each other is a perfect place to be because you both bought more Microsoft.
Yeah.
Speaking to exactly what I'm doing, it's up 3% this week. I told you that the NASDAQ week to date is now positive. The S&P, though, is still negative. Microsoft is good for 3% this week. Let's hear from you first and then you.
Yeah, so to me, look, I do think there'll be permanent damage to software companies, some of them in particular, and we can guess those. Could it be a Salesforce? I think yes. But in terms of Microsoft, they've been in front of this. They were early investors in OpenAI. Could you see some damage? Yes, and I backtrack from them being the biggest beneficiary of AI to them being, I think, neutral to slightly positive. And that means the stock is extraordinarily cheap at these levels. I think that there was a lot of panic in it. So I added to it. I didn't sell during the software panic. I did sell a year ago, but it was still a small core position. Now it's back to being a full-size core position.
Getting a pop. By the way, Satya Nadella, the CEO, is speaking within the next 5 minutes out at the Morgan Stanley TMT conference, San Francisco. So anything comes out of that, we certainly will let you know. But the stock's getting a bit of, I didn't mean to cut you off. I just wanted to note the move.
Arizona, I'd like to hear from Bill.
Note Nadella on the stage in a little bit, and you tell us more now.
Yeah, we've been underweight Microsoft. I mean, even after this ad gets us just almost a 4% weighting. And the late, great Charlie Munger, I mean, you wait until things test the 200-week moving average. It's going to prove to be a long-term buying opportunity. That's what Microsoft did. But it's also 2 standard deviations below its long-run PE. And, we see this as a big support. And I think it's time to start thinking about getting Microsoft to weight or near weight in your portfolio. And you're starting to see it right now. We talked about capitulation. Capitulation has happened in the software space, and that's driving Microsoft maybe from multiple lenses. Not only just people selling Microsoft itself, but the flows that are coming out of software.
Hey, pull this
now
out
to come
for
back
a year.
in.
You want to see a stock that's done a lot of nothing? Pull this out to a year.
This is Microsoft's Alphabet of spring of last year moment.
Draw a
Everybody
straight
hates
line.
it.
Draw
Here we
a
go.
straight line from 370. What is that? 373? Can't even see it. 370. Whatever that 370 number is. Draw it straight across the thing, because that's where you've been in the
And
last
it was
year.
up over 500. I mean, at one point it was moving and then gave that up fairly quickly.
We trimmed it ahead of its earnings report when software had that little pop up. So we feel very comfortable adding to it here. But again, I mean, I think this could be last spring where everybody hated Alphabet. This is that moment for Microsoft.
It's a proxy for OpenAI, just like SoftBank is. If you believe there's stability in the software names, this is the safest play. If software is going to have a recovery rebound, Microsoft is going higher. The challenge is beyond software for Microsoft, related to maybe a little bit of a slowdown in the Azure growth. Do you really believe that's sustainable over the course of time?
I don't think you'll see slowness at all in Azure
I
growth.
agree. So I don't think you're going to see that. I think it's a safe way to play it. If you want to play the recovery rebound in software in a high beta capacity, just go buy the private equity names.
Okay, well, that takes, at least the way they've traded lately, some guts for certain. What do you think about the mega caps, though? And this idea that, when the times are tough, despite, it's not like the questions about spending and the durability of the AI trade have gone away, but these are places to hide out in times like this, no?
Absolutely. Well, and I think it's a good sign that investors are hiding out in equities. So let's not focus too much on the fact that we rotated from small cap back into large cap. Let's focus on the fact that during a period of intense fear, investors still stayed in equities and rotated along.
That's right. Yields going up, right? Not the other direction as people were buying
within
treasuries.
risk assets. And also remember that before this, I mean, it hasn't even been a week. Before this, the market was in decent shape. Earnings were still very solid, surprising to the upside. AI CapEx was very much surprising to the upside. Those mega cap companies have really good balance sheets. They are in good fundamental position. So things were okay, if not pretty good, before a lot of this erupted. And in the software space, the market was a little rattled by everything that had happened in software. And full disclosure, I mentioned this the last time I was on the show, my final trade was IGV on January 20th, poorly timed. At that time, however, IGV was down 18% from its highs, so it seemed like a decent entry point. Of course, I did not anticipate a bunch of these announcements by Anthropic that would send it down another 20%, but looking at just that big drawdown in such a short period of time, I think we got to the bottom.
I was going to go right there. I'm glad you did. Because if you tick off the things that are driving the market higher, okay, oil lower, private credit feeling better today, and the IGV. It's now up 4% this week, the software ETF. So maybe you have, as Jonathan Krinsky suggested to us yesterday, been fully washed out. You look at CrowdStrike today, coming off the back of the earnings. Cyber hasn't traded well. It's obviously in focus in relation to the war and the threat of cyber attacks. But this stock, off the back of earnings, is up 1.5%. I come back to you, Bill Baruch, because their guide was pretty good. Yep. And you bought more of that. Tell me more.
Yeah, we bought more on Monday. I mean, this is ahead of earnings. We were confident that the pessimism was at a peak, and we wanted to get money to work in software. This is a great report. Record profitability, solid margins, attractive new product suite, secular tailwinds, and security and defense spending. I think this is a name that you have to have in portfolios at this level right now, and I expect it to perform.
Are you disappointed it's not up more today?
I am, but on the week, what is it, up 5% on the week or so?
I think a little more, even.
Yeah.
It may be up like more than 6% on the week. So maybe some of the move had already been anticipated.
People
By the
are
way, Morgan Stanley takes the target to 487. That's down from 537. Little optimism coming out, but there it is. Week to date, almost a 7% move. George Kurtz, the CEO on Mad Money, Jim Cramer tonight, 6 o'clock Eastern. It's an exclusive, and you don't want to miss that. What do you make of the cyber trade lately?
So the cyber trade is obviously something I do not have any exposure to currently, other than through the EIS checkpoint, and then obviously Palo Alto bought CyberArk, but it's still listed on the Tel Aviv exchange. I think you want to have some exposure there. That's why one of the reasons why I gave consideration and purchased the EIS. I said yesterday, Checkpoint Software is a name that individually I might buy at some point. CrowdStrike, obviously, I think it pulled forward a lot of what we're seeing in terms of the earnings release today. Palo Alto, another name you could ultimately own. I'm sure the strategy will go back into it at some point, but for now, we're sitting on the sidelines.
We got an important earnings report in overtime tonight, don't we? Broadcom.
Sure do.
We obsess over NVIDIA and everything that it does. Broadcom hasn't had a big seat at the table of the conversation lately. It should. Pull the stock out. I mean, you get a look at what the stock's done. You do a year, few years, whatever you want to do. What do you think? You own this, right?
We own it. I wasn't going to step ahead of it. It's still a very large holding in our portfolios. We've been overweight. We maintained that overweight, though it's come in a little bit just naturally. It's at the 200-day moving average. And so I think there's a lot of support down here. Forward multiple is 27.5. I think that multiple can even really come down if this stock doesn't really rally out of the earnings. I expect a very solid earnings report from them again.
Big report tonight. Look for revenue growth up about 29%, adjusted earnings up 23%. They have to give more color on what the trouble was in December related to looking forward over the next 6 quarters, the backlog of $73 billion that was a little below consensus expectations. They also have to defend against the software story. Jim Cramer's done a great job talking about this. Remember, 42% of their revenue is attributable to software. It's VMware. So they have to defend against that a little bit. They've got a great story to tell as it relates to the tensor processing units and the relationship that they have there with Alphabet. A little bit more expensive than where NVIDIA right now is. But look, it's been a core holding for us. We've owned this stock since October of 2021.
Are we still all, tensed up about NVIDIA, or can we feel better about the way that stock's traded? So it's up 5% over the last month. It might not feel like it because in those days after the earnings report, it traded so poorly.
Yeah.
But then we've had the turnaround.
I mean, it's our largest holding. We're about a 6%. We've added to it on when it was down earlier in the year. I think it is time to kind of put it past right now, and I think we're going to see a risk-on rally broadly. I think the software is coming out of it. The one thing that we're really looking at as at our portfolio is the CapEx AI spending. Now, some of the multiples we're seeing with Broadcom and NVIDIA have come down significantly, and the spending, the borrowing has been so loose. I mean, if somebody wanted $1 million, you don't ask for $1 million, you ask for $2 million, and I mean, you're getting loans, the no covenant loans, lacks collateral, they're very competitive rates. So that's what we've seen really washed out within this sell-off in software, and I think that leads way here. Why that they were trading at such lower multiples, and I think we'll see them trade at higher multiples going forward.
Okay, so chips, watching chips. I want to come to you, and I want to get to a lot more before we get out of here for a break. You trimmed Taiwan Semi.
Yeah.
Can you give me some details on that?
Sure. I mean, I started buying Taiwan Semi when it was in the 70s. It became just about twice the size of my largest core position. So I was actually late in trimming it, but it's still by far my largest position. Just from a risk and a portfolio management standpoint, I had to take some off the table. So that's the only reason. It's nothing about the fundamentals. I said, still by far, by leaps and bounds, my largest position. And everything you're saying positive about Broadcom and NVIDIA, they make the chips for everybody, period. Except for Intel's got their own fabs. So as you see growth there, you'll continue to see it at Taiwan Semi. Now, of course, the risk always is what happens with China. And I think that's a real risk, particularly as we deplete our munitions over in Iraq and elsewhere. You can see it. I don't think it stays worry, but at some point it becomes a worry. If I really worried about it today or over the next year, I wouldn't be in it.
All right. Let's switch gears completely and just talk about oil for a moment. I'm going to lead into a move so you'll understand why I've made this turn. So oil now is positive barely, but it's off the burner at least for the day or for the hour, maybe. I don't know. Who knows? We've seen a lot of that based on headline-driven stuff, Strait of Hormuz, et cetera. The administration is doing its best, whether it's the president, the Treasury Secretary, or whomever else, to relieve any sense that oil is going to stop flowing. Okay, that's probably why you're seeing the move that you have in WTI. you sold SLB. Why'd you do that?
We came in Monday more than just over a 10% weighting in energy, which is about 3 times the S&P 500. And energy's done really well for us this year. We wanted to, or needed to, we felt the need to monetize something out of that move. Now, SLB has been sort of trading sideways for the last, maybe a couple of weeks. It did not accelerate higher coming out of Monday. We thought it'd be time just to take that thing off, monetize the energy space. We have a nice couple other names between KMI, Exxon, LNG that are in there that we really like. So reducing that energy. Now, the thing to remember, crude oil responded and it's higher. It's not above 80 bucks WTI. And remember, Iranian oil was already off the market. Now, other than really not affecting anybody but China. And I mean, China has a great surplus right now. So oil is very tame, and so we wanted to make sure we monetize the energy out of that. Now, if they keep hitting infrastructure around the Middle East, that could start to change things. But if that starts to walk back, like we heard the news overnight that they're looking for some step forward in negotiations here. Iran is, and that's why the market's reacting like this, and that's why energy is not accelerating higher. But I think right now for us at a large weight in energy, we want to reduce that here. And SLB
I also think that China probably has had to talk to Iran and said, stay away from bombing out the infrastructure in Saudi, everywhere else, as close as they are, because otherwise that's where I would have gone after if I were them. So I think that has something to do with it, and that's the biggest risk to me, that they take out the oil infrastructure. But as you point out at the top of the show, they're losing those capabilities.
Sure. I mean, obviously, militarily, the might of the United States and the arsenal that we have, as the defense secretary, the secretary of war was speaking about earlier, it's not like that's going to remain an ability of the Iran regime, whatever is still existing of it, as the hours and the days progress. So I just think the overall tone of all of that has helped crude get off the heater. Now, even the estimates that are coming out, Goldman, okay, they take crude higher. UBS takes crude higher. We're not talking about huge jumps.
No.
Goldman to 71 from 62, Brent to 76 from 66, UBS 72 from 62. That's not 115.
No.
They hit 125. You start talking about that, you're going to have a different picture in the equity market.
All that does is reverse the bearish sentiment that has been in place for crude oil for the better part of the last 2 years. And coming into 2026, the bearish positioning. Iran does not control the price of oil. The United States controls the price of oil, as does Saudi Arabia. You're absolutely spot on with this, Scott. I like Bill's move with Schlumberger. Over the next several days, I will get out of the OIH, which has been a fantastic trade for me. We still maintain exposure to Schlumberger and Baker Hughes and Joe T. Do not get out of the refiners. The refiners are a very important energy holding, I believe, as you move through the summer. Maintain positioning in Valero, Marathon, and Phillips 66.
These conflict spikes in oil have always been short and reset much lower. So everybody thinks they're getting in early. They're all getting in late. So it's the same thing as the equity market.
Two things, crack spreads surging out of this. You see heating oil, diesel this week is just surging. And then as a commodity trader, the Sunday night market's open. I look at Sunday night, when you get news over the weekend, a lot of the time you get a high in oil in that open, a lot of time you get maybe a high in gold at the open. And I cleaned my commodity portfolio straight out. Got out of my crude oil call spreads, got out of gold longs, got out of everything. And then finally on SLB, earnings are trending the wrong way. They're trending down. So for us, it was just, let's move away for a little bit.
Let's move away for a little bit ourselves for a couple minutes. We'll take a break. We'll come back. We'll do the calls of the day. Plus, I've saved a move that Steve Weiss has made that we will tell you about right after the break. all's well with you and Netflix now, right?
Yeah.
Bought more?
I did buy more, and that is also a core position now.
Okay.
So if you recall, I got out because I just thought it was going to be dead money.
Yeah, you and a lot of other people.
Yeah, and at this point, and part of the reason, this informed part of my reason buying Microsoft as well, I'm looking at stocks that have already been through the fires, I've already been through the battles, and that's Netflix, and that was also Microsoft to a certain extent.
Some of the first ins become the first outs.
Yeah.
You know how much this stock's up over the last month? And a lot of it's more recently,
I didn't
obviously.
catch the bottom.
23%.
Yeah, I didn't catch the bottom in the 70s. But look, what I like about it is that Paramount believes they're much stronger with Warner. I think they're much weaker. I mean, with what they've spent, with the leverage, more than 7 terms of leverage, that's an obscene amount of leverage, and that prevents you from building out your business, because all you're focused now on is paying down the debt and the debt service. Whereas Netflix, they saved $90 billion in making this they can devote to growing their business and content. So I'm super pumped up about it. I think it's going to be a top performer this year.
Well, I mean, it was before the downturn that it took, and that was well before the news, obviously, of the bid. Tesla reinstated a buy today at Bank of America. $460 is the price target. They did have it on a hold, so they are back positive on that name, Bill.
Yeah, I think it's held so far where it really needs to, right around $400. There's a lot of support there, down to 370. The 20-day moving average is in there. The breakout from September. They're having success with self-driving, I think. I mean, you're seeing some news coming out of South Korea, positive sentiment there. And so I think this is where, if you like Tesla and you feel it needs to be in your portfolio, which I do, this is where you may want to think about adding to it, if not buying buying to get it in there.
What about Ross Stores? Traffic up, picking up, sales are up in the quarter. They reported.
Look, they're telling a story we already knew with TJX. Comp sales up 9%. The consensus was calling for 4%. Ross Stores up 7% today. They've already expressed that it's a strong start to the spring season. And right now, consumers are looking for the discount, whether it is low, middle-income consumers or whoever it might be, and it's clearly represented by TJX Ross Stores. You'll hear from Burlington soon enough. I don't like Burlington as much as I like TJX and Ross.
What about CAT? Target goes to 860. Overweight JP Morgan. So it's 739, goes to 860. Weiss.
Yeah, I mean, that's been a wild ride. I mean, take a look at this. I don't know which is more of a wild ride in my portfolio, this or Goldman Sachs, because they'll trade down 3-4% at a pop. But I like it. They're still extremely well positioned.
Look at that move.
Yeah, they're still extremely well positioned, still overvalued. But there's nothing to reset the value as long as the CapEx spend keeps happening.
How much of that is attributable, I was going to go there, to data center dig up?
I think a lot of it. I think a lot of it. A disproportionate majority of the move is
like a
definitely
big dig on steroids, right?
Yeah, except I don't see that change.
Pulte Group, buy 170 at Truist. What do you think?
But basically, the Truist note speaks about the home builders and the fact that probably 2026 has priced in the overall gloomy outlook for housing, residential housing. They're focusing on 2027, seeing a much improved environment, and that's why they suggest Pulte here. I think Pulte benefits relative to the other home builders just from a stronger average selling price.
Corning, overweight JPM, they reiterate that view. What do you think about that one?
Listen, this has been phenomenal for me. I bought the stock at 109 at the beginning of February. They have the $6 billion relationship with Meta through 2030, and it's all about fiber optics and their market share there. They're participating in the AI build-out after NVIDIA reported. You saw the analyst community increase some of the earnings as it relates to Corning. And then, they have the Gorilla Glass, and very strong market share as it relates to that.
Okay. Angelica Peebles has the headlines for us. Hi there.
Hey, Scott. Republican Representative Nancy Mace made a motion today to subpoena Attorney General Pam Bondi in the House Oversight Committee's Jeffrey Epstein probe. Mace is calling on Bondi to appear for a deposition regarding the Justice Department's handling of the investigation into the late sex offender and the department's compliance with the law requiring it to release all documents related to Epstein. Democratic Minnesota Governor Tim Walz appeared for a hearing today on fraud in his state, saying he wants to work with Congress to address the issue. It comes as the House Oversight Committee released a report earlier today claiming that he knew about the widespread fraud for years and didn't do anything about it. Walz, who dropped his gubernatorial re-election bid earlier this year, has denied wrongdoing. And a new study published today in the journal Nature finds that the world's sea levels are higher than calculated. Researchers looked at hundreds of scientific studies and assessments and concluded that baseline coastal water heights were underestimated by an average of 1 foot. Scott, back over to you.
Angelica, thank you. Angelica Peebles up next. A halftime exclusive interview. Our own Deirdre Bosa is at that Morgan Stanley TMT conference. She's got the co-head of investment banking live next. Well, we do have a nice bounce back. We're trying for one today, about 300 on the Dow. You've had certainly some relief in the price of oil. You've had some of the private credit names respond. The mega caps continue to draw interest as well. It is a perfect time to be visiting with the co-head of investment banking of Morgan Stanley. He is at their TMT conference out in San Francisco alongside our Deirdre Bosa. Dee, take it away.
It is the perfect timing, and Satya Nadella is on stage behind us with his interview at the Morgan Stanley TMT conference. Mo Asmal, thank you so much for being here, Global Co-Head of Investment Banking at Morgan Stanley. As Scott said, markets have bounced back today, but certainly volatility has been the major theme this year, especially in technology. As you've been here over the last few days, we're hearing from some of the biggest, brightest thought leaders in technology. What's the consensus so far?
So thanks, Deirdre, for having us, and great to have you at our conference. The simple answer, I think, is there's no consensus, but I will juxtapose what I heard a month ago, where we hosted about 30 CEOs at a much smaller event, all mostly software CEOs, where there was a little more panic, a little more confusion around what AI was doing. Today, this week at our conference, we're hearing really great, really interesting things. It's not all panic. Clearly, there are going to be some winners. There are going to be some laggards. There are going to be those that will thrive alongside AI, and there are going to be those that need to adapt or they will be disrupted. So I think the mood is actually interesting, positive, a ton of innovation. You've seen some of the companies that we're presenting today, and it's actually quite an interesting time to be here.
Right, and I've heard the questions are tough. I mean, a year ago, right, I was here, you were here, and it was, look at all of these things that AI can do, and now it's, how are you going to survive the AI disruption? So what separates a company that has reason to be more optimistic?
So I think what we're thinking about is this is a reset in many cases, right? And it's not just software. I know software is sort of in the eye of the AI storm right now, but it's going to sweep other industries. We've seen it a little bit in insurance, in real estate, in healthcare, and there's more to come. That's something that Dario hit on last night, that you're going to see more disruption across almost every industry. And so I think what you have to do as a CEO, as a board, as major shareholders is understand, what does this mean for our business? How do we adapt? If we cannot adapt, we're probably in trouble. And even then, there's a question, should we think about M&A? Should we think about scale? Sometimes scale is the answer. Sometimes a different pivot to innovation is the answer. And we're trying, amongst all the noise, we're trying to find the right signals to understand how can we help companies, particularly on the back of what is, we think, a very interesting time to do M&A, to be in the capital markets. We're seeing numbers from this time last year up across the board, across the street for the banking businesses. And it's a great time to be able to advise companies.
At the same time, the backdrop for deals should be terrible. We talked about volatility, there's geopolitics, there's this massive AI disruption and threat in some cases. So how does that impact what you're telling clients, particularly in the software space? Are they acquisition targets, or are they, dead companies walking?
Acquisition targets, some of them, if they don't act, I think what we're telling clients are, be calm, but have a plan. And that's really, really important, I think. If you don't have a plan, be prepared for disruption, maybe even collapse. But what we're thinking about right now is you've got really interesting companies that can act. And in the backdrop of, obviously we're dealing with some geopolitics right now, but the markets are pretty stable. Cash balances are very strong. Earnings in this country in particular, very, very strong. So you've got a strong corporate backdrop, strong macro conditions. Now's the right time to do M&A if it's the right thing for your business.
That's M&A. What about the IPO landscape? This is the year, people are anticipating the big blockbuster, OpenAI, potentially Anthropic, SpaceX. How has the landscape shifted? Does it still look good for those companies?
Well, as you know, we had an IPO drought for a couple of years, post-COVID, 22, 23, really quiet years. A little bit of a rebound last year. And this year, we're going to continue to see more and more companies decide to move from being a private company into the public markets. And we're going to hopefully see some larger deals over the next 12 to 18 months. And I think the question on many people's minds are, can this market handle potentially larger deals than we've ever seen before? And my answer is yes. You've seen a lot of institutional investors being able to participate in the private markets, but the public markets is where many of these companies will eventually land up, and there'll be plenty of capacity to get these deals done.
I want to get into some of the specifics. I know you probably can't say which company can or won't, but for example, in Anthropic, which was just designated a supply chain risk by the White House, how do you go public under that?
Look, there are going to be some good and bad news events around all these companies, and I think it's just part of their evolution. I think you're seeing the numbers are getting bigger and bigger. The usage is getting stronger and stronger, and I think the uptake in the public markets will be very strong for all these companies. I won't talk about specifics, obviously, but we're going to see, I think, some very interesting access to the capital markets this year and next.
Well, Mo, thank you so much for being with us. First time on CNBC, so thank you. And
Thanks,
look forward to the rest of the keynotes today. Thanks.
Good to see you.
Scott, I'll toss it back to you at the New York Stock Exchange.
All right, good stuff. Yep, Dee, thanks so much. Mo, of course, to you as well. Coming up, we'll talk some global markets because one just had its worst day ever. There are implications for the stocks you might own. We will find out how the committee's playing all that next. All right, welcome back. We want to go international for a moment. There is the Korean Stock Exchange, worst day ever. It's down, you see, 12%. You know, in a week in which you've had multiple shops come out and suggest that their highest conviction overweight calls are emerging markets. Liz, I'd love your thought on that call, if you have a broader thought on what that chart, and just how you're thinking about all this right now.
So, first of all, Asian markets tend to exhibit a lot bigger swings than U.S. markets, obviously, and just developed markets in general, particularly Europe and so on. So a big swing like this, I shouldn't say to be expected, certainly the biggest one in history for South Korea, but the market was up 160% since the beginning of 2025. So what happened in this peak fear moment in the last few days is that the stuff that was exhibiting really strong momentum took it on the chin a lot harder, and I think that's what happened here. South Korea is now down about 19% from its highs. I would imagine, and I mentioned this earlier in the show, absent a recession, we probably stop right before that bear territory or right around bear territory in South Korea. I am bullish on emerging markets. I talked about this on Closing Bell last week with you, Scott. One of my calls for the year was China. I'd love to expand that into emerging markets broadly and say that I think they are insulated from a lot of this geopolitics volatility that goes on because of the emerging market to emerging market business that they have. I do believe that the dollar stays weak after some of this de-escalates, and I think EM is a good spot to be.
What do you think?
I agree with her. I mean, the EEM, the ticker EEM is a great spot to look at. And, you know, I think we own Micron in portfolios, and that's followed a lot of this, the memory trade that South Korea is really hinged on here. But if you own a ETF like EEM, you're diversifying. Now you got Samsung and you got SK Hynix as like the 2 and 5 holding in there, but you're surrounding with Taiwan Semiconductor, Tencent, Alibaba, other names. So it's a great spot, and I think we're going to see really good momentum kind of once this all settles out.
I just wonder. Okay, so like since you mentioned that, like look at Hynix, for example. If you look at a chart, I'm guessing that it's sharply up and to the right.
Yeah.
Right.
Yes.
Like all of the other memory-related names. So if the weighting of that stock in that index is that large, and you've hit peak memory, as some are suggesting, and you have any kind of rollover, are you not buying this at what might be perceived as a top?
No, that's not exactly what I'm saying, because we've corrected a little bit. We've pulled back. I like the memory trade in general, but if you buy EEM, you're getting Samsung at 4.7, you're getting a Hynix at 3.0 on as a weighting within that, and you're getting other names around China that are included in EEM. The thing about it is you see all the 13Fs that come out over the past couple of weeks. Everybody's talking about all these big hedge funds that own EWI, which is just South Korea. And money can be chasing into that. I think you're chasing in just to South Korea itself. You're going to be maybe on the wrong side, or you're taking a lot more risk than you really need.
I think Liz said really one of the more important elements of all of this is where does the dollar go? And I do believe the dollar continues to move lower. That supports the emerging market story. Inflation is coming down. And when you think about the emerging markets, you want to think about who is actually exporting oil, and that is Mexico and Brazil, EWW, EWZ. Those two ETFs hold enough assets that I'm comfortable with it. You could also make an argument for Norway and Malaysia. I'm not sure how you get at the exposure there in some ETF wrapper that has enough AUM.
Okay. The other ILF, South America, and you get Vale in there. That's pulled back sharply too. So we own ILF and EEM.
Okay. Santoli on the other side of this break. Senior markets commentator, overtime co-anchor Mike Santoli joining us now. What are your thoughts as you see this market rally today?
Yeah, Scott, I mean, the geopolitical shock and the threat of the oil shock, I think, has been experienced by investors, by collectively the stock market, as a repositioning shock. So it was an occasion for a real chase liquidation out of the globally crowded areas of the market, bringing together some of the most extended relationships. We've talked about it, semis versus software, global versus U.S., emerging versus, U.S., and gotten some relief to some of the most beat up areas. Some of the things have fallen into place. You have a nice spike on the VIX chart. You're up from 28 intraday down to 20 or so. That often means the fever has broken. I do think you still have to recognize, though, that we've now priced in a relatively benign scenario of a contained outcome in the Middle East, something that seems like the market can look through for a while. Obviously, oil's got to behave. Energy stocks not having a bid yesterday was a pretty good tell of that sort of culminating in the near term. So I still want to see the S&P get above 6950, which is last week's high, to say that we're kind of out of the lower end of this range.
You get a little private credit help, those names.
Yeah.
It's just the boil everywhere, Mike, just seems to have been relieved at least a little bit in the interim.
No, there's no doubt it has. It certainly would have reset sentiment a little bit. It chased people out of areas they thought they were too comfortable in. The question is whether all this internal volatility can just people can just brush themselves off, pick up, and resume an uptrend, or if it's just kind of we're still stuck in this mode of kind of internal tension in the market.
All right, we shall see, and I'll see you in a couple hours. That's Mike Santoli at the NASDAQ, as you see. Finals are next. I hope you'll join me 3 o'clock Eastern today. We'll see what this market does over the final hour with Liz Ann Saunders and Adam Parker and the NHL commish. Gary Bettman is going to join me on the gold medal bounce that the National Hockey League is seeing. Look forward to you joining me then. Let's do some finals. Liz Thomas, you're first. What do you got?
I'm going to cover my eyes for this one, but I'm doing IGV again. I hope I don't have to apologize for it again. I think we bottomed, and I don't think the entire space gets displaced.
All right, so we have had a nice little bounce. We'll see if it holds. Stephen Weiss.
I'll tell you what, I've been getting my butt kicked by Baba, but I think it's getting to a level. I'm going to add to it. I'm just waiting for it to flatline a little bit.
A lot of the Chinese tech names have gotten hammered.
Yeah, this is extremely cheap. So I'm going to add to it. It's not a full position.
LNG, Cheniere, gets paid on volume, U.S. natural gas. You look at Qatar, LNG shut down, European prices skyrocketing, sitting pretty, maybe a breakout.
Your guy Pasquarello puts a note out during the show. You pick Goldman Sachs for final trade. I know how you roll. I'll see you at 3.
Thank you very much, Scott. Jensen Huang is about to speak. Tech execs are getting ready to meet at the White House. And is the Mag 7 back on top again? Welcome to The Exchange. I'm Kelly Evans. The market is certainly taking a breather after heavy selling following the U.S. attacks on Iran. The Nasdaq is leading the rebound today, and it's now up nearly 1.5%. This all follows a decent ADP jobs report and a strong ISM services read this morning. Dow's up 336. All of that said, the 10-year yield is moving back up towards 4.1, 407 this hour. The private credit names are also bouncing back, helped by Oppenheimer, reiterating Blue Owl as a top pick. A rebound in software helping those stocks as well. But some bigger upward moves in the memory chip names today, with Western Digital up 7%, Seagate up 8% to lead those gains. All of this helping South Korea's market, where futures are higher after it booked a 12% overnight drop. That was its worst one-day loss in history amid soaring global oil prices and after it had more than doubled over the past year. Let's begin with this market rebound today as investors breathe a sigh of relief over the oil price situation, helped by comments from Treasury Secretary Scott Bessent this morning.
We believe the market is very, very well supplied. We are in contact with many of the countries around the world via the IEA. There is a gigantic SPR, not only in the U.S., but around the world.
Now, investors are still looking for more specifics on the safe passage for oil tankers through the Strait of Hormuz and insurance for crude carriers and cargo ships operating in the Persian Gulf. But as I mentioned, here at home, the ISM Services Index jumped to 56.1 in February. Look at that chart. Better than expected, highest level since July of 2022. That said, is stronger data plus higher oil prices now going to cause more upward pressure on inflation? On that, let's bring in Larry Adam. He's the Chief Investment Officer at Raymond James. And Adam Posen is president of the Peterson Institute for International Economics. Welcome to you both. Larry, I'll just start with you and the market action, which is telling you what exactly?
Well, I think this is pretty much par for the course, that when you have these geopolitical events, you see some near-term volatility driven by what's happening with the headlines. But as we've been saying, as long as it doesn't last more than like 3 or 4 weeks, it probably just remains headline risk. But if it does last more 3 or 4 weeks, then I think we're going to have to start to look at how it's going to change our ultimate economic and targets for the year for different asset classes.
Larry, are you positioning at right now for kind of continued outperformance in materials and industrials and energy and kind of the physical atoms that are going into this build out of AI and of capital spending more broadly?
So when it comes to energy, we're actually a little bit more cautious on energy. Our target for the end of this year for the energy sector is $55 to $60. So as a lot of these events start to dissipate, I think you're going to see downward pressure. And that's a sector that you have to remember that has very little, if any, earnings growth this year. So I'm a little bit more cautious there. The areas I would prefer are going to be more technology, where you have attractive valuations and earnings growth of around 30%. And then the other area I continue to like is industrials, because I do think, as you mentioned, we're going to have to see the replenishment and build out of military armaments around the world. And the industrials continue to pick up the benefit of, building out AI and the power grid here in the United States.
Yeah, it's a powerful triple tailwind there. Adam, let me turn to you. Prior to the Iran conflict breaking out, of course, we had a couple of negatives. We had that PCE report, which had a lot of worries, and PPI had a couple of worrisome data points in there. In some ways, the consumer part of that is tracking for maybe 3.6% inflation growth now. So we've seen this shifting around. even before the oil price spike, where people were worried that we might not have any more rate cuts this year. Adam, what do you see as the inflationary outlook right now?
Kelly, I'm quite worried. As you may recall, Peter Orszag of Lazard and I had put out a forecast suggesting inflation could reach 4% on headline CPI by the end of the calendar year. Some of the factors you mentioned, energy, consumer prices, lagged pass-through of tariffs, lagged effects of the deportations of migrant workers, but also fiscal stimulus continuing, loose monetary policy, and as we've seen with the latest services data, pretty active labor market. And so whether or not you buy that, we've got this new inflation data coming in, this new worries and pressures from the actions in the Middle East. And I think that's just going to push further up on inflation. I want to be clear, it's not because there's going to be direct hits in the US economy very much in terms of energy. India in particular, Europe, some other places, Japan are much more vulnerable to that. But there is going to be almost certainly additional military spending, almost certainly some kind of thing coming out of Treasury or the White House to try to cushion energy blows for people. This comes against a background where gas prices are going to shoot up, and that was one of the few visible prices in normal people's lives where they had moved down, not just stopped rising.
I read Dean Mackey over at Point 72, and he is pointing not just to oil, Adam, but also to things like the fact that we haven't seen more of a slowdown in the rent or housing proxy. A lot of people have been expecting that to kind of be more supportive, to be more deflationary than it's showing. And it's weird because do you follow the Truflation Index? You know, this kind of an alternative, kind of real-time data point that is way below where the reported inflation is. And so I think there's still...
I don't.
Yeah.
Sorry, I don't buy the Truflation Index. I don't think it's well designed. I think it's much better to do as my Peter's colleague Jason Furman does, which is take a bunch of the government-produced, much more solid indices at different monthly frequencies, 3-month moving average, 6-month moving average, 12-month moving average, trimmed, not trimmed, and look for the common components. And what you see there is a much more solid inflation outlook in the sense of much less decline. And on some of them, we're moving upwards. We passed bottom. I would not bet money on the Truflation Index as opposed to the real indices.
One more on this, and then Larry, I'll turn back to you. But Adam, can the White House look through this and say, okay, yes, goods prices are jumping. Yes, the ISM prices paid in manufacturing hit 70 the other day. You probably saw that. It was a big number as well. So is this just because people are front loading ahead of whatever now might happen with tariffs? Or do you think this is going to be a lasting move? How hard is it going to be to get inflation from 3 or maybe 3.5%, if that's truly where we're headed, back down to closer to 2?
I think it's very hard absent a recession, Kelly. And I said something I almost never say, which is I felt a little badly for President Trump during the State of the Union because there's nothing much he can do on affordability, especially if he wants to pressure the Fed to lower rates. It's going to be very hard to do anything about affordability in that environment. And this just makes it harder. I think he and the Fed, both the White House and the Fed, will take an attitude of, yes, we'll look through this. This is temporary. It won't necessarily undermine things. But I think from the Fed's point of view, that's the wrong play because there's so many other things in the background that you can't count on inflation expectations staying low.
Larry, do you want to weigh in on that? Do you share these concerns, or do you have a little bit more sanguine view of things?
Well, even before the war, we were expecting an uptick in inflation early in this year. And I think what's happening with oil prices only accentuates that you're probably going to see an uptick in the early part of this year. But we think the path of inflation continues to be that it moves higher through the first half of this year. But by the time we get to the midpoint of this year, to the end of the year, I think we once again get on a deceleration path for inflation going into next year. And I think as we go into 2027, I think that could be a year where you do start to see inflation approach that 2% target that the Fed's been talking about. A couple of drivers, I do think that owner's equivalent rent will start to show up in the numbers. I think productivity gains continue to drive prices lower. And I do think that goods prices will start to move lower as we go forward, because I continue to see a little bit more pressure to the downside, especially during the most recent shopping season that we saw. So I'm pretty comfortable that inflation is still well contained, and that's why I think the Fed has more of a laser focus on employment conditions going forward.
Yeah, fair enough. Although, again, if they're looking to cut, they're not getting a ton of help from that ADP report. Quickly, Adam, the Piper Sandler folks think that we could see CPI go up by about a point in the coming months, year on year. I mean, that would be a real headline problem for the Fed.
Yeah, it would. And I think the issue, Kelly, is how much persistence do you get? I mean, how much does it build on itself? Not necessarily some huge wage price spiral, but does it just shoot up and come back down? And the Fed is likely, particularly with the pressure from President Trump, but also because there are people like Governor Waller making the case that these are one-off shocks, and that there are pressures not to move in an aggressive way either way ahead of the midterm elections. I think the Fed is likely to just sit tight, and I think that's going to ex post prove to be a mistake.
All right, gentlemen, thank you. And Larry, by the way, you point out something that Nowruz, March 20th. We have some time to talk about it between now and then. But do you think that date, which is the Persian New Year, do you think that would carry significance in terms of us coming to some sort of positive development by then?
Look, that's more of a hope, but I do think that it would be interesting that if you look back previously, President Trump has wished the Persian culture a happy New Year's through Nowruz. So if you think about it, if you think about that 3-week time horizon that we were talking about, that puts you pretty much right around that date. So I'm hopeful that that could be, with Nowruz, it's spring with the new beginning type of mentality. So maybe it is a new beginning with our relationship with the Middle East, particularly Iran. That would be a wonderful thing.
I like the food table they always put out. That's quite the spread. Gentlemen, thanks. We'll leave it there for now. Really appreciate your point of view, both of you, Larry Adam and Adam Posen, joining us to kick things off today. Let's turn our attention to tech now, where the Mag 7 are up 1% this week, while the broader markets are struggling a bit. My next guest says the AI giants are at peak negative data right now, but could ultimately be in for a better year. Let's bring in Barton Crockett. He's senior analyst at Rosenblatt Securities. Barton, we are not even talking about Apple. They did a 3-day launch event. Normally you give them a prime time, and there's a new iPhone, there's a few things going on, but is that fine? Do they need all this oxygen, or is it fine that these events kind of come and go and the stock, can kind of perform? And what do you make of them and the other Mag 7 names right now?
Yeah, look, I mean, if Apple can, be steady as she goes in this environment with all of the memory cost surges, the supply chain issues, that's a flex. I mean, that just speaks to their power. I think the announcements that they're putting out this week are, very consistent with their goal to be able to improve gross margin meaningfully year over year in the June quarter, and a decent harbinger for what they might be able to do for the balance of the year. So, they're executing well. They're out of the eye of the storm. They're not plowing CapEx into huge data centers like the hyperscalers. And they're able to kind of navigate the storm they have in front of them. So they're in a comparatively kind of decent place right now.
How would you rank your, kind of the Mag 7 favorite to least favorite? Or is it fair to still break them out and to talk about whether this trade, broadly speaking, could have a reversal for a little while?
Well, look, where I'm, most focused is really on kind of the internet services companies, and in terms of my specific coverage. And I do think that there is an opportunity for the narrative to look better. When you mentioned the kind of the peak negativity, is that CapEx in aggregate for, Amazon, Google, Meta, Microsoft is up like 2/3, 66% year over year, basically evaporating free cash flow of those companies. It's not going to get worse. I mean, they're not going to grow CapEx 2/3 next year and have negative free cash flow. So I think you're at peak concern about the spending, peak concern about their ability to convert that into profits. And, I think that as you look into next year, this idea of, hardware wins everything, the services, software stocks kind of lag. For the hyperscalers, at least, there could be a different perspective, which is, maybe their spending on hardware kind of, starts to level out a bit, and they start to milk the revenue from the investments that they've made. And that could, harbor for, an interesting setup for these companies. In our coverage, we've been recommending Meta because they have great revenue growth and we think they'll get a return on their investments. But we also think Amazon, if they're able to navigate some of the noise with Anthropic, is interesting here as well.
Yeah, you're a hold on Apple. It's not a sell. It's kind of reflects the performance that we've seen there. Also on Netflix, I mean, this is one that's been getting some more negative attention lately for some of its core viewership trends. You're a hold or a sell on that one?
So I'm a hold on Netflix. Look, I think that Netflix is a great company. I never expected them to win this bidding war for Warner Brothers Discovery. But I think the stock trades at around 20 times EBITDA, and I think their EBITDA is growing at about a 20% pace. So I don't think it's mispriced. If the stock were to get disrupted, I could see looking for opportunities. I think that, their growth reflects a maturity arc, which is, the scripted kind of stuff that they've been investing in resonates. They do really well with that. But a lot of the next generation's kind of viewing habits are skewing towards user-generated areas where they're less well kind of positioned. And, that's going to be a challenge for them, I think, longer term. And you see that reflected in viewership. They don't report subs anymore. They do give us some viewership data. And the growth over there has been, not really rocket ship. So the grower of revenues really is coming from their ad push and their ability to kind of penetrate more of the world. But the amount of time that people are spending on Netflix viewing, is really not terrifically exciting at this point. So, it's a well-managed company in a maturing environment.
And they up against a big fight against YouTube, I think, from here.
Correct.
But still a nice rebound in the share price up until now. Barton, thanks. Appreciate it. Barton Crockett joining us with Rosenblatt. Speaking of Netflix and what they perhaps aren't doing, don't miss a big interview tomorrow morning. Paramount Skydance CEO David Ellison is sitting down with Julia Boorstin to discuss their deal to buy Warner Brothers Discovery. That'll be around 10 a.m. Eastern on Squawk on the Street. Looking forward to that. Coming up, the revenge of the software stocks, outperforming semis by the widest margin in over a year. Was AI's threat to the industry exaggerated? We'll ask Box CEO Aaron Levy about that and the DoD AI clash ahead. But first, our next guest says Brent oil could still hit $90 a barrel. He'll join us to explain and look at where we could go from here in the Iran conflict. The Exchange is back after this.
This is The Exchange on CNBC.
Welcome back. Oil prices turning positive and going higher again in the past hour after opening lower for the first time since the Iran war began. The White House says it's working on measures like military escorts for tankers through the Strait of Hormuz and a cap on risk insurance rates. My next guest thinks prices could go higher for now before reversing lower in the back half of the year. Let's bring in Citi's global head of commodities research, Max Layton. Max, a lot has transpired since we last spoke. Welcome back. And we mentioned your price target potentially of 90 near term on Brent. Where are you for WTI, and how are you thinking through where the price could go?
So the next week or so, we think we will be trading at $80 to $90 on Brent and around $5 to $8 lower than that on WTI. I mean, I would just, I'd really highlight that the risk is extremely high at the moment, and over the next few days, a push, any continued push for regime change, and you really risk Iran using its missiles on regional energy infrastructure, and that would then obviously lead to a response, which may include Iranian energy infrastructure, and you can quite easily see how this becomes much more problematic for the oil market.
Let me just dwell on this for a moment, because it sounds like you're describing what I thought we already saw take place, but you're saying there's a whole layer of this that could potentially be still to come, and I don't want to say worse, but more impactful from an energy point of view?
Yeah, I think the assumption over the last few days is that the reduction in missile use and drone use by Iran means that there's, while a reduced probability of a further escalation, because of some kind of military dominance to the point where, they've kind of, the US and Israel have kind of reduced the threat of Iran. And that appears to be true, but that doesn't mean there's no threat at all. And the threat, I think, still exists. And, as things progress in terms of the US and Israel being successful in their goals, Iran may see that as, increasingly likely leading to regime change. And this obviously then leads to them to respond in an asymmetric or in an escalatory way, and that's so I think we're certainly not out of the woods yet. That's where my head's at.
Yeah, and so what then gets us towards? And our first guest has kind of talked about this. Many people have said this the last few days, that the energy stocks got a bit over their skis this year. Some of the moves that I thought didn't really make sense, even based on the oil price prior to all this. So, and you yourself have a much more modest view of where oil prices might be in the back half of the year. Just talk about that.
Yeah, of course. I mean, I think the stocks benefited from the broader market strength, the potential for Goldilocks economic environment in the US and more broadly globally, as President Trump was, the idea was he was looking towards the midterms. You'd have a more dovish Fed through the second half. And, there was a broader kind of demand, positive, inflation negative outlook into the midterms, which people were, I think pricing in risk assets broadly, and I think the oil longer duration assets benefited from that. We happen to have, in terms of our kind of more bearish 6-12 month view on oil, we happen to have as a baseline view a de-escalation with respect to Iran. So firstly, we think this moves from an international conflict where you have 20 to 30 million barrels at risk to an Iran-specific risk, which is more like 2 to 3 million barrels of exports. And that transition leads to the first leg lower in prices, perhaps around a month's time or so. And then the next leg lower comes on the basis of peace deals with, it's our base case.
Yeah.
We have to take a view. It's a base case of Russia-Ukraine. Peace deal happens towards the end of the summer, and that takes you the next leg lower.
Well, that would be a much better back half than what we've started off. And I should mention, too, it's not just oil that moves to the Strait of Hormuz, it's commodities as well, fertilizer and a bunch of other things. So that's something to consider. Maybe we'll talk more about that next time, depending on how this plays out. Max, for now, thanks. Appreciate your time today.
Anytime.
Citi's head of commodities, Max Layton. Coming up, results from Broadcom are headed our way after the bell today, with the options market pricing a 9% move. The shares are down about 7% this year, while the semi ETF is up 11%. Is a reversal due for this $1.5 trillion name? We'll talk about that next. Welcome back as we're tracking this market rebound right now. NASDAQ still leading the way, up 300 points. Dow's up 262. President Trump met privately with Coinbase CEO Brian Armstrong yesterday before throwing his support behind crypto firms and their fight to get the Clarity Act through Congress. That has Bitcoin and crypto stocks soaring today. Coinbase is up nearly 16%. It's at 210 and it's leading the S&P. Of course, Bitcoin broadly is down more than 40% still from its record highs. Coinbase is down by more than half. Strategy and Bullish are nearly 70% below the highs. Elsewhere, Ross Stores hitting an all-time high after reporting strong results, including record EPS this morning. It's also raising its dividend and announcing a $2.5 billion share buyback over the next 2 years. Those shares are up 7.5%. And on the flip side, GitLab hitting an all-time low after the company gave disappointing full-year guidance, overshadowing an earnings beat. That's an 8% slump for GTLB. Now to Broadcom, which has become one of the biggest companies in the world, helped by demand for its customized chips for AI. But the shares have hit a soft patch lately, coming off their third straight month of losses, down 20% in that time. Let's bring in Christina Partsenevelis with more. Christina?
Well, Kelly, Broadcom's setup heading into earnings, dare I say, is tricky, and it really comes down to this. The numbers are expected to be strong, no doubt, but there are structural questions a beat alone won't answer. Start with customer concentration. So nearly 80% of Broadcom's AI chip revenue is tied to one customer, Google. And Google is already diversifying, working with Taiwan's MediaTek on a more economical version of its AI chips, which could cost Broadcom market share. Also why we saw share price decline just over the last few months. Then there's the margin story. Broadcom's fastest growing business is AI compute, but it carries structurally lower gross margins than AI networking and significantly lower than software businesses. So the faster AI compute grows, the more pressure on the overall margin profile. Add to that, roughly about 40% of the business is still software. That means slower growth, different multiple, which helps explain why Broadcom right now trades at roughly 30 times forward earnings compared to NVIDIA at just 22 times. So often you'll have people say Broadcom's more expensive. So you're paying more for a company with more customer concentration and margin headwinds. And then there's the AI backlog. Last quarter, it came in at roughly $73 billion, which sounds impressive, no doubt, until you realize it was right in line with what the street already expected. Tonight, that number, of course, needs to move much higher because if NVIDIA couldn't rally on a 73% revenue growth and near perfect print just last week, Broadcom's definitely going to need more than just a beat, Kelly.
All right, looking forward to those results later. Christina, thanks for that setup. Appreciate it. Christina Partsenevelis. To Seema Modi now for the CNBC News Update. Hi, Seema.
Hi, Kelly. Elon Musk is in a San Francisco courtroom today defending himself over investor allegations that he committed civil securities fraud during his Twitter buyout in 2022. Twitter investors filing a class action suit against him, alleging he engaged in a scheme to depress Twitter's share value in order to pressure the board to sell for a lower price. Musk has denied the allegations. The Trump administration today is offering more than 1 million acres in Alaska's Cook Inlet for oil and gas drillers. It's a key test of the industry's interest in investing in the region and the first of 6 Alaska offshore oil and gas auctions that are mandated through 2032 as a result of the president's One Big Beautiful Bill. And Republican Congressman Dan Crenshaw of Texas became the first member of Congress to lose renomination in this midterm election cycle. That's according to the Associated Press. Crenshaw was the only GOP House member running for re-election who didn't have a Trump endorsement and lost to hardline conservative state rep Steve Toth. Crenshaw was first elected to Congress in 2018. Kelly, back to you.
A lot of moves there. Seema,
Yes.
Thank you very much. See you soon. Seema Modi. Coming up, software stocks on pace for their best week since December. We'll ask Box CEO Aaron Levy about that and about the Pentagon's clash with Anthropic. That's next. Welcome back. We've got some news out of Washington. Eamon Javers, what's happening?
Kelly, we've got a new filing in International Trade Court, which seems to indicate the Trump administration acknowledging that any refunds of tariffs paid by U.S. corporations last year under IEEPA would be paid, if they are paid, with interest. Now, bear in mind, I'm doing this, and I'm not a trade lawyer, but in this filing, we're getting a declaration by Brandon Lord, who's the Executive Director of Trade Programs at the Office of Trade at U.S. Customs and Border Protection. And he's asked by the judge in this back and forth, what's the situation effectively with interest on all these tariffs the companies paid. What he says is, in accordance with applicable law, any validated refund of IEEPA duties would include interest. Then he goes on to say, regardless of entry type and liquidation cycle, CBP still requires a review period to ensure no violation of other customs laws and no other duties, taxes, or fees are owed. So a nuanced response here, stipulating that, yes, if we have to pay these IEEPA tariffs back, we'll have to pay them with interest, but also saying that we're going to still require a review period to ensure that no other duties of any other kind are required here. So ultimately, I think what we're looking at, Kelly, and the trade lawyers are going to jump on me on social media on this, but I think what we're looking at here with this filing is the Trump administration saying effectively, yeah, if we owe them, we will owe them with interest, but there's a long way to go between here and there. There's a whole long review period, a lot of bureaucratic process between now and whenever they might write a check.
And a lot of companies are already selling to firms who, of course, are buying them up, at cents on the dollar, hoping now potentially to get made whole plus then some. So that money is already moving around. Eamon, thanks very much. Appreciate it.
You bet.
Eamon Javers. The software stocks are rebounding again today with names like Box up more than 8%, 9 now. It's the best day in nearly a year. The IGV's up about 2. Investors are weighing whether the sector sell-off has seen a bottom. And Deirdre Bosa brings us Box CEO Aaron Levy to discuss that. Welcome to both of you. Deirdre?
Thank you, Kelly, so much. And Aaron, thanks for making time.
Yeah, thanks. Good to be here.
We talk to you every few weeks.
Yeah, exactly. It's good to just have a pulse check of what is going on with SaaS.
I think I called you like the SaaSpocalypse spokesman at one person.
I really don't want that position. Thank you. If I can remove that from whatever label you guys have.
Fair enough. But your insight is extremely valuable, and feels like there's been maybe a little bit of a shift over the last few weeks. It was like indiscriminate selling to now a little more nuanced. Your stock is up some 8% today on the back of earnings. Some other, companies that have pulled ahead. What do you think has actually changed?
Well, I I think there certainly was probably your words of indiscriminate selling of just there's a rotation of out of software into more of the kind of capex dependent parts of the infrastructure stack, and then I think we are in a period where investors are starting to look at what actually is happening, what are the contours of what will play out with AI agents inside of the enterprise, and so I think I'm judging off of some of the investor conversations I've had at this conference. I think things are settling a little bit where people can kind of open up and say, okay, what parts of the stack are disrupted in different ways? What use cases are agents going to fully be able to subsume? Which ones will they still need other software or infrastructure for? The position that we've had from the beginning is actually agents are going to be the biggest users of software in the future. That doesn't mean they're going to use all software. So you have to figure out what software actually is going to be kind of core to kind of agentic use cases, which versus which ones won't. And at Box, we're building a platform that helps agents actually leverage the unstructured data, the kind of critical context in your enterprise, to be able to help you go and automate your workflows. So agents actually need a file system to be able to do their work and to be able to actually go and accelerate the knowledge work that everybody is looking to bring AI into the enterprise for.
Right. It feels like investors are getting more familiar with the technology and its limits, what it can and can't do, what you need third parties for. We were talking, I know, about OpenClaw off camera.
Yeah.
But let me ask you about sort of the different models. You just added Claude to Box AI Studio.
Yep.
Anthropic just got blacklisted essentially by the Pentagon. Does that give you any pause about who you partner with, how you use the technology?
Actually, it probably does the opposite. It puts us even more focused in being a neutral, open layer for any AI model that is obviously, kind of an approved strategic, model. We think that the idea of kind of having all of your data get sucked into one model or another is, puts you in a risky position. Instead, what you want to be able to do is have a data layer that then connects to any AI system that you want. The Pentagon issue was sort of an unanticipated example of that, but there's a lot of reasons why you want to be able to have choice in which AI agents and AI systems you want to be able to use without having to move all of your data between those systems. So I think it actually further reinforces the separation that you want to have between your agentic systems and the AI models from the places where you want to have work get done and the software layer that manages how those agents are leveraging that information.
Right, and I guess even more broadly, how do you sort of look at, as a CEO yourself, how do you look at the events of the last week or so? I mean, one thing for the Department of Defense or the Department of War to walk away from a contract, but that supply chain risk designation put onto Anthropic. How do you think about that?
I mean, I'm hopeful that there's going to be some recovery of that partnership and that relationship. It's hard when you're not in the room, kind of seeing where the actual kind of bright lines are being set. We have a great partnership with both the U.S. government and Anthropic and OpenAI and other providers, and we certainly hope for the industry's sake that things can get a little bit smoother on this front.
Okay, back to OpenClaw. I feel like
back to OpenClaw, yes.
It's a little nuanced, and it's hard, I think, if you're not sort of right here like you and I are. I wonder if you could explain that to our audience, and, like, what the use is, because Jensen Huang was just on stage behind us, really saying that, what did he say, probably the single most important release of software probably ever.
Wow.
What's your view?
I think what OpenClaw, so far the paradigm of AI and AI agents has been this idea that you as a user will tell an agent to go do something, and it will effectively do it on your behalf. I want the agent to write code for me. I want an agent to review documents. I want an agent to go and summarize my email.
Even text.
Exactly. Yeah. So that's what that's so far what these AI systems have been. OpenClaw actually took it one step further, and it basically said, what if this agent was actually its own effectively autonomous system that was always there at all times, but it almost has its own identity. It's not you. It's actually another thing that is running at all times. And you give it tasks, and it goes and does those tasks for maybe hours and hours, and it can act either, in theory as you, or it could act in theory as what you maybe would have an assistant or another kind of person in your team actually go and do. And so what it opens up is a little bit of this new terrain of agentic systems, which is, what if you have these sort of nearly fully autonomous systems that you're still in control of, but they're not acting as you, they're acting actually as their own identity. Now, what's interesting is with the growth of things like OpenClaw, but this was true of even things like Claude Cowork and other systems, these agents actually need many of the kind of critical primitives that we need as people inside of an organization. They need a computer, they need an identity, they might need an email account, and what they certainly need in our world is they need a file system. They need to be able to store off their work. They need to be able to load the information that some other user is trying to share with it. They need to be able to keep track of their memories.
Right.
So they're going to need a persistent storage layer that is extremely secure, that is going to be able to let an enterprise govern the work that they're doing, that's going to let you actually have auditability of that work, and that's the platform that we're building.
Right. So new customer base almost is agents.
Well, literally, like it might be 100x the size of our existing customer base.
Right, and you're seeing that with other companies like Databricks too, sort of who's actually they're building the databases for. Last question though, that seems really scary for a lot of software companies. This is still kind of a new idea, OpenClaw, and the idea of like a totally autonomous agent for Wall Street, but does that ultimately just like accelerate sort of the software sell-off in certain sectors, especially if you're kind of if you're a UI?
I do think that some elements of the UI change. I think as a company right now, you have to be API. As a company right now, if you're in software, you have to be API first. So like fundamentally, if you do not have an API into your system that an agent can use just as easily as a human could have used the UI, you're basically dead in the water. So the future is going to be API forward. And the companies that have strong APIs into their systems and manage the workflows or the data that those agents are using, those I think actually are going to see a tailwind due to agents, because that's just another constituent that we never had before that's now using these technologies. So we actually think there's a lot of upside for many parts of the software stack, maybe not all, but at least the space that we're in, agents love files. Files are really the kind of native work unit of an agent. That's how they actually keep track of what they're doing. And those files have to get stored somewhere, and they have to be secured and governed somewhere.
Right, so you got to have an API. Always great to get your insights, Aaron.
Thank you
so much.
Good to be here.
Kelly,
All right.
hand it back over to you.
And
Thanks.
Aaron, thank you. So, spokesperson for the SaaS apocalypse. I will make sure that goes up every time.
He loves that title. Keep using it.
Thank you both. Coming up, mortgage demand actually sprung back last week as rates neared a 4-year low. But the builders are down as the 10-year has back up today. That includes Hovnanian, NVR, Lennar, KB Home. A little different story for the building materials stocks, though. As you can see, Ethan Allen and Mohawk among the best gainers in the space. We'll have more on the housing situation right after this. Welcome back. Mortgage rates are back above 6% now, but last week's brief dip below that level touched off a flood of demand. Diana Olick is here with the numbers. Diana?
Well, Kelly, mortgage rates did jump higher, as you said, on Monday as the Iran attacks renewed concerns over inflation. Today, they're slightly down to 6.07%, according to Mortgage News Daily. But last week, mortgage rates hovered around a 4-year low with a few days at that 5.99%, which is seen as that emotional tipping point. And that had homeowners and potential home buyers calling their lenders. Applications to refinance a home loan jumped about 14% from the previous week and were 109% higher than the same week 1 year ago, that according to the Mortgage Bankers Association. Applications for a mortgage to buy a home rose just over 6% for the week and were 10% higher than the same week a year ago. Now, despite some rough weather in the Northeast last week, buyers are clearly getting ready for the all-important spring housing market. The bigger issue, though, for buyers is it's less about the mortgage rates and more about supply. Supply is higher than it was a year ago, slightly, but the annual comparison is actually shrinking week to week, according to Realtor.com, when it really should be rising given today's lower interest rates. Supply is still well below where it was pre-pandemic. Now, rates could take another run in either direction when we do get that all-important jobs report on Friday, but for now, we're just hovering in this sort of short range right above 6%, Kelly.
Yeah, perhaps it underscores how important it is to see that 5 handle for buyers, at least, even if it's just a marginal savings. Diana, thanks. Appreciate it. Diana Olick. Coming up, the South Korean Kospi was the best performing stock market in the world last year, but it's fallen more than 18% over the past 2 days for its biggest 2-day drop since 2008. So is it the perfect buying opportunity? Your next guess answer might surprise you. Feeling good if you owned the Kospi last year. It soared 77%, boosted by the AI trade. A lot of that, as we've talked about, 2 major names like Samsung, SK Hynix. But major reversal this week. Amid concerns about the economic ripple effects of the Iran war, the Kospi is down 18% since Monday, though still up 21% this year. Seema Modi is at the New York Stock Exchange with a look at the sell-off and the fallout, Seema.
Kelly, this historic move that we've seen in Korea's stock market is directly linked to what's happening in Iran. As Goldman Sachs notes this morning, Korea is the most oil-sensitive country in the region with a high percentage of its imports coming from the Middle East. So that's pushing investors to sort of take some money off the table. It does follow a massive rally, as you just alluded to, as valuations of AI companies in the U.S. started to get rich in the fall of last year. Investors started to look for AI picks and shovels names in Asia, and Korea has been a favored destination. destination, housing two powerful memory chip makers, SK Hynix and Samsung. With this year's gains, these two companies now make up about 50% of the MSCI Korea ETF weighting. Now, putting this big sell-off into perspective, Kelly, Korea is still up. South Korea is still up about 40% this year. That is the widest divergence with the Nasdaq in 17 years, according to CNBC analysis. JP Morgan strategists still see this as a favored market to own, pointing to structural reforms and earnings revisions, but they also acknowledge that these stocks in Korea will remain sensitive to the developments in the Middle East.
It was a wipeout. I think of their 800 listed stocks, only 10 finished higher yesterday, down 18% in 2 days. Seema, thanks. Appreciate it. Seema Modi. So is this sell-off now the perfect opportunity to buy some of these high-performing markets? Let's bring in Tim Seymour, the CIO of Seymour Asset Management and a CNBC contributor. And are you buying Korea here? Tim, welcome.
I don't think you have to buy it today, but if levels on the EWY, which is the ETF we'd be referencing, I think around 120. The issues in Korea, Seema laid them out well. We've talked about Korea, you and I, multiple times in the last 6 months. It's a combination of the whole AI memory story. Korea, I should say, South Korea is always cheap. Samsung is particularly cheap. If you can get exposure, and even if it is foreign flows through the ETFs, that's been a big part of the trade. The other dynamic is, I think, just the leverage in the local markets, the trading vehicles, the fact that you've got a president, a former day trader. I mean, this is the financial press loves to talk about this was a former day trader, President Myung, who is someone that also, though, is really focused on corporate reform, is focused on equity markets and depth. And people that have been investing and emerging for years know that South Korea probably would be investment grade if not for the chaebols and some of what seems like to outsiders the manipulation of that market. But I think it's really just the accessibility of the market, and it speaks to the fact that we're talking about an ETF that a lot of U.S. investors have used to get that exposure. So there's a lot of things that moved into this massive sell-off. I do think if oil prices stay in a range here, this is a place to start looking. The question U.S. investors should also ask is, were they very valuations at SanDisk and Micron and some of the big memory players here? Because that certainly is part of the question. How bubbly has this been, even if Korea is cheap? I want to buy Korea. I probably want to buy it lower. I certainly don't need to buy it today. I think if you have not been in this trade, there's no reason to try to buy this move. I think we're all of the view any headline could send oil prices $10 higher. And if you are a trader, I don't think you need to own it here. If you're an investor, I think you have an opportunity.
So at 120 and we're at about 134, and maybe friends in the back, we can show like a 5-year chart here, because when reading the Greg Abel letter over the weekend, Tim, I was reminded that Berkshire's position is almost equal between its Japanese, company ownership and U.S. company ownership, which is a striking fact to think about. And there's the 5-year performance. The Kospi is only up actually 67%, which is, 8, 9, 10% a year. Like, it's nothing that special. Maybe we can even, guys, show the Kospi over like a 20-year basis and compare it with the Nikkei, because I guess here's the point. If Berkshire sees long-term value in some of these shareholder-friendly changes Japan's making, and if Korea moves in the same direction, you know more than I do if they're kind of tiptoeing in that direction, Tim, then I could be more persuaded. Because otherwise, after a parabolic move and like a 20% reset, you think, no way should you get involved with this thing. But maybe this is actually a way to draw attention to a bigger sort of seismic shift that could happen here.
No, I like your comparison to Japan, and Korea has been, as an export market, historically has often been compared to kind of the new Japan, and corporate reform, focus on governance. These are big issues in both these countries, and Japanese equities are going higher for a lot of reasons, but definitely because of corporate reform. I like Korea for this backdrop. I also just think from the MSCI weighting perspective, Korea's now moved up to be almost in line with Taiwan and China. Wow. It will pull back a little bit after this. I think it's gotten a little bit hot. And again, I think it is a case where I'm not sure South Korea should be weighted on a par with Chinese equities, even if all of this is a function of what you can own and how you can get at it.
I wish we had more time, Tim. I just want to ask one more on this, and it is the North Korea question. As more are wondering, look, the president's done something on Venezuela, it's done something on Iran. What if things heat up in North Korea?
I tell you what, I don't think that's in South Korean stocks, but I'm not sure that's a political event I'm counting on.
Yeah, exactly. I know it's impossible. One of the things, as Steve Sosek said yesterday,
think about it. Interesting.
Sometimes equities can't discount everything. They just the events sit over to the side until we know what to do about them. Tim, thanks for now. Appreciate it. Tim Seymour. That's it for The Exchange. I will join Brian Sullivan for Power Lunch right after this quick break.
Day 5 of the Iran war, but stocks and your money are coming back as the world looks for any hopeful sign. Welcome to Power Lunch, everybody. Energy front and center this week, oil and gas. They're calm right now, even as the U.S. Navy does something it has not done since World War II. We'll talk about that and what's ahead for oil as the global markets all react. And will, by the way, the president's plan to protect shipping really work?
We've got some great insight coming up. I'm really looking forward to this. We also have some tech executives from Amazon, Google, Meta, Microsoft, and more meeting with President Trump this afternoon. The administration is pushing tech giants to make a formal pledge to shield consumers from rising electricity costs. A critical inflection point for the AI trade more broadly, as focus now shifts to how AI expansion will be financed, regulated, and powered. And that said, let's start today with the markets. The major averages are rallying on some stronger than expected economic data, while still wary of oil prices as the U.S.-Iran war enters a fifth day. Here to discuss is Rebecca Patterson, the former chief investment strategist at Bridgewater Associates. She's currently a senior fellow at the Council on Foreign Relations and now has a weekly podcast, I've seen this, on global macro events called The Spillover. Welcome. How do you come up with names? That, you know what, we'll talk about that another time.
Yes.
What do you make? Are markets too complacent about the Iran war right now?
I think so, yes. I think markets are somewhat complacent right now, only because the cone of outcomes is so large. I mean, the good news is the data this morning reminded us that the U.S. economy went into this on a solid footing, right? The service sector is hiring, new orders are strong. That's great. The beige book, I'm guessing, is going to be pretty benign going into the crisis. All good. The problem is now that we're in it, does oil stay here around $80 a barrel? I'm talking about Brent crude. Does it spike? And that's an issue of time. And Brian, you've been doing this for a million years. You know this like I do. Once those storage facilities fill, if the ships can't take that oil out of storage and ship it, they're going to have to shut in production. And that's the risk moment for oil prices. And on our podcast, The Spillover this week, we had Natasha Kneva from JP Morgan. She runs their commodity research. Iraq shut in production yesterday, I mean, the rest of that region will shut in within a couple weeks max. So the clock's ticking on both sides.
Yeah, and something I wanted to show, you've probably seen it, maybe some of our viewers have seen this, and it's a little bit disturbing. It's video from a U.S. submarine, and what I referenced, and we're going to show it to you now. And this is video, and again, folks, it's a little, it's war. It is a U.S. submarine. That is an Iranian naval ship. And the U.S. submarine launches a torpedo and blows up the Iranian naval ship. And I'm assuming something very bad happened to those sailors on that ship. And we are at war, and I'm only showing this because, Rebecca, I feel like there's a part of this market that is undervaluing that. That's real war. That's ugly. That is dangerous. It's deadly. But that's what's happening. And the market is kind of acting like, oh, we've got a little dispute going on here. That's more than a dispute.
Yeah, my brother worked on nuclear submarines in the Navy for several years. So I have a little bit of insight on this, not much, but I definitely appreciate
Well, it just shows what's happening. That's a real war. That's the first torpedo attack on a foreign ship
since World War II.
1945.
Yes, yeah, I know, I understand. And I think, look, for investors, I pray and hope that all of us understand that there is a huge human element to all of this. And in a way, you have to compartmentalize that, because if you didn't, you wouldn't be able to do your job. I mean, frankly, it would be too upsetting. So I think there's that aspect of it. And this is a, no pun intended, deadly serious moment we're in. From an economic point of view, you think about, can the U.S. achieve its aims in this war quickly before the storage issue makes oil prices go not from 80 to 100, but even higher than that. And you see that hit American consumers, American businesses. How does this play out around the world? Like, when you think, I was reflecting the other day, of all the financial assets in the world, oil is probably the single most important. Think about it. You can't drive your car. You can't get product from a company to a consumer. You can't run a business without energy. And it is a global market. So the U.S. might be a large net exporter today and a large global producer. But if we can't get oil where it needs to go globally, the global economy stops.
And it so much depends on the timeline and how quickly now we can prevent them from having to shut down production. The two announcements about that yesterday on the insurance piece of this, and then also kind of the naval escort, how are you thinking through that? Because investors still have a lot of questions about the actual implementation here.
I mean, look, Treasury knows that higher oil prices could hurt the administration and the party in the midterm. So they need to do everything they can to try to mitigate any potential rise in the price. So I'm not surprised at yesterday's news. I would not be surprised if the International Energy Agency, I believe that's the right body, correct me if I'm getting this one wrong, could come out with some strategic reserve release similar to what we had in 2022 when Russia invaded Ukraine. We had about 120 million barrels put on the market on April 1st.
Like a global SPR, effectively.
Correct, a global SPR, global supply.
And it is the IEA, and they talked about it.
Thank you. It's a one-off, and it doesn't change the trend. It's like one-off intervention from a central bank. The Treasury news, the question is, will ships say this is enough? And what we heard from Maersk today is it's not clear it's enough. They're saying we're pausing. We're not doing anything right now. Because even if you get the missiles and missile launchers done from Iran, we've got this lovely thing now called a drone. And they don't cost that much. And it's very easy to have a lot of them, and they can do a lot of damage too. So again, my bottom line is there's just a big cone of uncertainty, and it's really about time. Can we get our war aims quickly? Will Iran agree to peace and a new regime quickly? Will we get it done before we have oil prices going parabolic?
We're learning a lesson about the reality of the world because we've been so focused here in the United States because we're geographically isolated from so much of this stuff. We're just blessed to be lucky with the geography that we have.
Yes.
We've been focused on AI, right? Is Gemini better than Anthropic? Now we're going to start focusing on can the world eat, because it's not just oil, it's natural gas.
Yep.
It's fertilizers, it's aluminum, all the stuff we don't think about. Water. So water.
Facilities in the Middle
Clean
East.
drinking water. Plenty of water, not a lot of clean drinking water. And there were some reports out that Putin may be thinking about cutting back on liquefied natural gas sales because they know they can't beat us in a real war, what we just saw.
Right.
But they can do a lot of economic pain.
Yeah, I mean, Russia, there's a lot of cross currents on Russia right now from what's happening in Iran, but Russia is winning in a couple of ways, right? Higher oil prices create more revenue for Russia that allows them to continue the war in Ukraine, and it takes the focus away from Ukraine. And that gives them a little more flexibility in some short-term period. And to your point, Brian, on liquefied natural gas, I mean, poor Europe, like they can't catch a break. First, they're getting it too overdependence on Russia. Now it's from Qatar, but Qatar has shut in its liquefied natural gas facilities because they were hit. And so Europe is seeing the same inflation shock, energy inflation shock that it did in 2022. How is that going to affect monetary policy? How is that going to affect growth? Again, it all depends how long this lasts, and we don't know. And I think that risk premium, it is getting priced in more in Europe, as it should.
I was surprised that Europe was so resilient. Brad and I both talked about this, but after that energy price shock, which was so bad and so great to see the stock markets come back the way they did the last couple of years, and people would say, there's financial deregulation, there's growth, there's defense companies, there's some positive things going on there. But how does that experience, you think, then inform what might happen now?
Well, I mean, one of the reactions we've seen so far this week is some profit taking on that global diversification trade.
Yes.
Right. 2025, some of it was enthusiasm that you're seeing some growth catalysts overseas, much lower valuations. Some of it was I want to diversify a bit from the U.S. for a variety of reasons. But a lot of capital went to South Korea, to Japan, to Europe, to emerging markets. Part of the reason the dollar's a little stronger this week, it's not the safe haven per se. It's Americans who had said, I'm going to take more overseas risk, saying, maybe I'm going to take a little off the table. And so that capital coming back, you sold dollars to buy your Korean stock, you bring it back.
Do you think it was weird that we didn't see the 10-year go back below, the move there was a little bit counter trend?
So I think what's happening in the bond market right now is a combination of inflation risk and term premium. So what you're seeing with the Fed funds futures is that the market is removing some of the rate cut hopes it had this year. So the market is looking at the war as more of an inflation risk than a growth risk for now. And you see that in the 2-year yield, which is up quite a bit. In the 10-year yield, what I think you're seeing more than anything else right now is just a bit more term premium in that, i.e. risk to loan the government money for a longer period of time. Look, this is me speculating. This is not a cheap thing to do, right? Guns and butter. We're not spending money on butter right now, on the consumer, on social safety nets. We're spending money on guns. And when 3 planes go down, that is $97 million a plane. Think about the money we're spending as a government for Venezuela, for the Middle East. It might be for wonderful reasons. I'm not questioning the justification.
But it's real. The inflation is real.
But it's real money. Yeah. It's real money that can't be used for something else.
I think to your point, it's going to affect what the Fed here does, but it's probably going to affect what the European Central Bank
100%.
does more than us because of those inflationary pressures you just mentioned.
And it's worse than you even said. So for a country like Europe, you have the shock from higher natural gas prices, and because the dollar is going up, that means the euro is going down. And so you also have a weaker currency there, which also pushes up inflation. So they're getting really a worse stagflationary shock. This can hit growth over time if it lasts, and it pushes up inflation from commodities and the currency. So it puts the European Central Bank in a tough spot. I mean, we just saw comments from the Reserve Bank of Australia a few days ago suggesting they just raised rates in February. They might raise them again. So one thing to keep an eye on, again, it all depends on the duration of this event. But if it lasts long enough and or prices in oil and gas go up enough, you could get central bank tightening that actually tightens global financial conditions. That eventually starts weighing on stocks more than what we've seen so far. Again, it's all about the clock ticking.
This is the whole, argument before the 07-08 collapse. And again, we don't have over-leveraged home prices or anything like that, but you had these soaring commodity prices at the time, and this whole argument about how much the Fed should tighten or not in response to that.
The big difference is in 07-08, soaring commodity prices were demand-driven. Today, it is a supply shock. When it's demand-driven, you can have strong equities and strong commodities because the demand means more revenue for companies because people are spending more. This has nothing to do with demand. We're taking supply out of the market.
Yeah. And that's that makes people poorer and unhappier everywhere, basically.
The U.S., I'll leave you with this. The U.S. Economic Surprise Index has been going up. That's good news. Economic data better than expected. The U.S. Economic Policy Uncertainty Index, also going up. There aren't a lot of moments where those things go up together for very long.
Unmatched expertise and insight. Rebecca Patterson, thank you.
Thank you.
Really appreciate that. Senior fellow at the Council on Foreign Relations. And the podcast is called The
Spillover.
Thank you. See, we spilled over.
Yes.
All right, we got some breaking news from the Federal Reserve just weeks before its next monetary policy meeting. Rick Santelli's been flipping through the beige book. What are some of the highlights or lowlights, maybe, Rick?
Well, I'll tell you, first we should put a kind of boilerplate on this. The confrontation with Iran started on the 27th, and the beige book was written on or before the 23rd of February. So really, in many ways, there's issues here that may be changing. But having said that, on growth, most districts, moderate. Moderate was the word, okay? On the labor market, stable. On prices, moderately higher. And on wages, moderately better. So everything seems to be okay with the economy. It doesn't seem as though that big area on prices has gotten any worse, and it didn't seem as though the labor question marks, we didn't see any significant decrease in the outlook for labor. But all of that may change, especially the pricing side, considering what's going on with the Iran conflict. Now, having said that, people are smart in the market, Sully. You know, if you look at an intraday of twos, tens, and dollar index, there's very little movement. We could argue we're maybe a half to 3/4 of basis point higher in yield on a 2-year. The tens have been stuck at 407, and the dollar index really was at 89. Now it's at 87.5. This morning, we did have some very good news. When you looked at the PMIs, especially from S&P Global, their final reads came down just a little bit, but the ISMs were really strong. So all things considered, I think it was very good numbers today, and that was reflected partially in the markets. But you know the big story. The big story is all about energy. It's about how the dollar's very strong because we're self-sufficient. We potentially can export more LNG. You discussed all the issues with Europe. And indeed, whether it's Europe or Asia or what's going on with South Korea and their ETFs, all of that, of course, is going to be affecting some of the variables I just described that are covered in the beige book. Kelly, back to you.
Thank you very much, Rick. Appreciate it. As that 10-year yield hovers just below 4.08. Rick Santelli. Still ahead, we are closely monitoring the White House, where big tech execs could arrive any moment to sign a major power pledge. And energy prices are on the move again on the 5th day of the Iran war. The Trump administration saying the U.S. will provide support for oil tankers transitioning the Persian Gulf. Still, WTI crude fractionally higher today, around 70